market, I think, is more focused on the near-term effects of tariffs.
The markets will cheer a narrower approach to tariffs.
Markets have been sort of underestimating how much the Trump administration likes tariffs as more than deal-making.
I don't think any of us know. I'm not even sure the administration knows what the final set of tariffs are going to look like.
We're still in this waiting game. Things are proposals right now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday on a two-day winning streak on the S&P 500, leaving behind a five-day slide, the longest losing streak going all the way back to April of last year. Equity futures on the S&P 500 up by about 0.1%. On the Nasdaq 100 up by 0.11. Going into a big day for economic data. A little bit later on today we'll get the jobs openings report. Then on to tomorrow, ADP and jobless claims and payrolls just around the corner. In our survey, the median estimate is about 163. The single name we have to start the program this morning with, though, is Tencent. Tencent is getting absolutely hammered in today's session. We are negative by more than 7%, Lisa. A blacklisting from the United States of America.
Yeah, designating Tencent as a military company. This adds to the list, the growing list of other companies. They also had a battery manufacturer that is a component of Tesla that they added to the list. Question here of what this is, especially with the tit-for-tat developing with China reciprocating with a number of companies saying that the likes of some of the big U.S. companies, including NVIDIA, also are potentially at risk for them.
These kind of designations, and to be on this list, which actually stems from a list that came out during the Trump 1.0 administration, basically means these companies cannot sell into the U.S. military. But then there's the reputational risk if you're a U.S. investor on why you'd want to get involved. And the concern is about these specific companies, what they have to report back to the CCP. My big question is why, in the final days of the Biden administration, are they going after these top two companies?
The sitting president, Joe Biden, by the way, is determined to remind everyone he is still the sitting president of the United States because they have been incredibly busy over the last few weeks.
Incredibly busy when it comes to things like oil and gas leases across the United States. We are still waiting, and it should be in the next few days in terms of more sanctions on Russian oil and gas. There's going to be a number of measures that Biden is going to take on the final days out of office.
As we close out his final days, we're anticipating the first few days of the Donald Trump presidency, which most people assume started in early November. And yesterday was that first classic day of the Trump era. That first classic day of getting a report from the Washington Post. We sat here, we read it, and we said, wait until you hear from the incoming president. What did the incoming president do? Batted it away.
Basically, totally inaccurate. I'm not watering anything down. They're not going to be narrow tariffs. What I thought was interesting was the moves of the markets. We were talking yesterday about how maybe you can learn more about what the market does than maybe what the headlines are at this point. The fact that a lot of those moves stuck, that dollar weakness stuck, and that the move was significant in terms of dollar weakness, euro strength, Mexican peso strength. And yes, it was traced after Donald Trump's rebuttal of the Washington Post report, but not completely, shows how offsides this market has gotten with dollar exceptionalism, U.S. exceptionalism, and how much has to happen to really undo that.
When it comes to the Trump world and how they operate, and there's different factions, remember Terry Haynes also talks about a cabinet of rivals. You are going to see the sausage making in real time more than I think the market has been used to over the course of the last 4 years.
Whipsawed from one report to the next. The euro, by the way, to Lisa's point, stronger for a third consecutive session. Euro dollar north of 104 again, 104.23 and positive on the day by about 1/3%. Coming up this hour, we'll catch up with Julian Emanuel of Evercore, calling 2025 an inflection year for AI. Erik Nelson of Wells Fargo as Canada searches for a new prime minister. And Torsten Slok of Apollo seeing upside risk to inflation. We begin this hour with stocks looking for a third straight day of gains. NVIDIA unveiling new products and renewing optimism over AI demand. Julian Emanuel of Evercore writing, with consumers enthusiastic on AI adoption, yet sentiment in corporate America relatively muted, 2025 is the critical AI adoption inflection year. Julian joins us now for more. Julian, good morning.
Good morning.
And a happy new year. It's good to see you, sir. Let's get that out of my system.
Is it statute of limitations there?
We're getting close to
7 days. Okay.
We're getting close to mine. Friday. But before we get there, Happy New Year, sir. 6,800 base case for you on the S&P 500. Middle of this year?
No, that's our year end.
Year end.
Yeah.
Okay. We've had a couple of guests come on this program say that the man of the year is potentially not going to be Donald Trump. It's not going to be Jay Powell. It could well be Jensen Huang. Do you agree with that?
He made a pretty good case last night for that being the case. Look, go back to the start of this bull market, October of 2022. AI has been literally the one constant theme. A month later, ChatGPT was unveiled to the world, and you've had this incredible enthusiasm building. We all use it in our daily lives. And what we've seen is that corporate America has been slow and cautious in rolling it out. The bigger companies have adopted it more quickly. And the work we did a year and a half ago basically pointed, looking at past adoption curves, as 2025 being the big year. And basically what you heard last night at CES is that there are lots of reasons in terms of how the technology has evolved to believe this is going to be the inflection.
You alluded to it. The big tech firms certainly haven't been slow and steady about investing in all of this. We've seen the capex ramp up big time in the last couple of years. Adoption, I think, is the key point here. How close are we to us sitting here around a table and me reading out headline after headline of job cuts after job cuts because these companies are adopting this technology and they no longer need the staff?
Well, I think that's been part of why it's been, cautious and steady but not explosive yet, is because there is a sensitivity around this idea of job cuts. And frankly, when you think about it, the economy, as strong as it is in the U.S., is actually going to set the backdrop for that transition to occur more seamlessly than it might otherwise be if we were, growing sort of, call it sub 1%.
If this adoption does start to happen, are the big tech players like NVIDIA the ones that are going to keep benefiting the most in the stock market? Or are you going to see it broaden out, which we haven't seen so far this year?
Well, in general, you have the biggest names in these kinds of technological revolutions. It's not a winner take all, but it's a winner take most. And that's what we've seen. And I think part of what the misunderstanding was a year ago or a year and a half ago, when we all thought, well, there are fewer barriers to entry to using AI simply because you don't need desktop, you don't need the lay cable like you did in the internet revolution. Well, you do need people to deploy. You do need people to supervise and understand how the data gets worked. And that leads into the bigger names with more capital and more budget being able to, really dominate the playing field.
When you start to talk about big numbers, John, you were mentioning about how much capital some of these big tech companies are putting into it. Last week, Microsoft announced another $80 billion into their AI data center build out. You talk about this. Most of that, who would that benefit? NVIDIA. And it raises this question, as we've seen this year start out the same way that we saw last year really end up, which is big tech continuing to dominate everything and almost masking weakness and concern that you're seeing under the hood and other potential names. Is that going to be the contour of 2025 in terms of the stock performance?
Well, we actually think that you are going to get the broadening this year. And if you think about it, right, the deregulation backdrop that we're about to have in the incoming administration is profound. But if you think about the capital market cycle, what may be different this time is in thinking about the rest of the world, we think there's going to be more activity in mid-cap names simply because those kind of companies don't have as much exposure per se to Europe and to China. And so the regulators there won't be as much of an issue to getting deals done, down the market cap.
Why haven't we seen more of that, though, now? Already pricing in. You think we've seen enough?
Oh, we've seen a lot of it priced in. I mean, look at the rip in the regional banks, if nothing else. There's a lot of that excitement priced in, and it's just a question of time, in our view, before the deals start to happen, because it does make sense.
Okay, so if you're focused on Jensen Huang being the most important person of 2025. Can we talk about the second most important potentially in terms of what this market cares about, and that's the incoming president? What did you make of yesterday, and what does it tell you about how the market what they should be paying attention to in terms of the whipsaw we saw between headlines and how they reacted?
I think we can all be forgiven for not believing or thinking that this new year is 2025. not 2018. 2018 was really the year where all of the policy initiatives got unspooled, and literally you would have, I mean, we would write our research reports Friday afternoon, then you'd hear a tweet and we'd have to rip it up all again for Sunday publication. I think we all need to get used to that. But the cadence of the market being 3 steps forward and 2 steps back does not mean that we're not still in this bull market. It just means it's more volatile, which it should be with valuations where they are.
I remember a lunch we had together in late 2017. You won't mind me sharing this. And you talked about the low volatility trades and the risk of them exploding going into 2018. It was followed by Volmageddon. Do you think this is a 2017 setup or an 18 setup? How do you think about what kind of year we're going into?
Our base case is for volatility, episodic volatility. I mean, think about it, right? We saw that number, 2.5% core PCE, hit the screen on December 18th, and then we had a massive volatility spike. We go back to August, there was a couple of memes about yen carry trade unwind, and the VIX went to 65. But we're still in a bull market, but that's the world we're living in.
This takes us to bond yields. Are we at the mercy of the bond market still in this equity market?
I wouldn't say at the mercy, but it is much more important than it has been in the past, because it's going to be part of what guides the ability of the incoming Trump administration to achieve what it's trying to do. You know, if yields start moving towards 5%, the feedback might be, well, some of the policies are perhaps more inflationary, or yes, we've got to figure out what to do with the debt ceiling. But for equity investors at these valuations, you have to be sensitive to bond yields.
Which raises the question about whether the most important economic data point of today is going to be JOLTS at 10 a.m. Eastern, or whether at 1 p.m. Eastern, when you get the 10-year auction, that's going to be the most important economic data point at a time where you're seeing a disproportionate increase in longer-term yields versus short-term ones. That 2s10s yield curve is now the steepest going back to 2022. Is this a good sign or a bad sign?
Well, so this speaks again to how data is now different in this post-pandemic environment. If you look at the last 50 years, going from inverted to steeper usually means the recession is right around the corner. Well, it doesn't mean that at this point. The economy remains very solid. From our point of view, the recession risk in the coming year is low. The credit markets are telling you that. But it is something that we will have to continue watching, because simply the absolute price, yield price of the 10-year, look, over this cycle, when you've gotten towards 5%, that's when all asset markets have run into problems. We think that could be a possibility at some point this year.
Julian, it's good to see you. Happy New Year.
Thank you.
Thanks for being with us. Check out the bond market this morning. The 10-year at the moment is up by a single basis point, 464. Go to the very long end of the curve. Let's talk about 30s. The 30-year in America, yields we haven't seen going back to 2023. On the 30-year, we saw that headline yesterday here stateside. Go to the UK. Levels we haven't seen since 1998. Lisa, what is behind these moves in the bond market? Because the why, the what, is more important than the number sometimes.
In the United States, there's a twofold question here about how sticky inflation is and what the deficit is going to look like in the issuance of debt and how much that's going to factor in. In the UK, you add to this sort of stagflationary environment that you see with inflation data all across Europe performing to the upside, surprising to the upside. That is a downside surprise, a negative surprise compared to what people want to see. It just goes to the heart of the existential angst of the moment, which is, are we underappreciating just how sticky inflation is and how pernicious that could potentially be accompanied by slower growth?
Look out for Torsten Slok of Apollo on this very conversation later this hour. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Mark Carney, the former governor of the Bank of Canada and Bank of England, is considering running for Prime Minister of Canada to succeed Justin Trudeau. Carney has received support from Liberal lawmakers and supporters who want positive change and a winning economic plan. Carney holds a series of business and philanthropic positions, including serving as the chair of Bloomberg Inc. Treasury Secretary Janet Yellen spoke with China's Vice Premier He Lifeng a week after the U.S. said the Chinese state-sponsored hackers had breached about 100 Treasury Department computers. Yellen expressed concerns about malicious cyber activity. The Treasury Secretary also warned of consequences for Chinese companies that support Russia's war in Ukraine, as well as Chinese industrial overcapacity that she says is harming U.S. business. McDonald's is no longer setting aspirational representational goals. It's a revamp of its approach to diversity, equity, and inclusion policy. The company is retiring its DEI pledge in its supply chain and renaming its diversity team as the Global Inclusion Team. McDonald's cited the evolving landscape around DEI in the U.S. as a factor in its decision. And that's your brief, John.
Danny, thank you. I could talk about this topic all day. I think it's one of the major shifts taking place in corporate America at the moment. I think we have to acknowledge up front there are some legal issues, potential legal issues that corporate America has to navigate here. But I'm pretty cynical about all of this. This was never about values. It was always about selling product and selling services. And I think, as you've seen over the last decade, and we've talked about this repeatedly, these companies wanted to sell to a progressive consumer and insulate themselves from the regulatory impulse of the left, which is why they took on all of these values to begin with. Now we're seeing a major shift. I think they've got to worry about a conservative consumer. Think Budweiser, think Target, other examples. And I think they now need to be concerned about something they haven't thought about for the best part of a couple of decades, which is the regulatory impulse of the right, the Republicans.
Well, that's where I was going to go. How much of this is catering to consumer preferences or consumer pushback versus the political shifting winds, and how much are those two things intertwined? And that's sort of a question as we see an increasing number of companies really shift away from DEI.
Take probably the greater focus here on the regulatory front, and we'll talk about Meta a little bit later. Up next on the program, tariff confusion.
There's a question of what could actually be implemented with executive authority versus congressional authority. I think it's very plausible that a lot of these tariffs are going to go on, including some very aggressive tariffs on China, but the implementation could kind of ramp up over time.
That conversation up next, live from New York City this morning. Good morning. Live from New York City, welcome to the program. Equity futures right here with a lift again, up 1/10% on the S&P and the bond market. Check out bond yields, up again, just by a single basis point, 464. But Lisa will tell you there's an important auction a little bit later. She'll tell you more about that later on. 464.22. Under surveillance this morning, tariff confusion.
The problem is that there are tariff principles that the president-elect has put out there in terms of wanting to make sure that the U.S. and its trade partners are on more equal footing from a tariff perspective. But then there's a question of what could actually be implemented with executive authority versus congressional authority. I think it's very plausible that a lot of these tariffs are going to go on, including some very aggressive tariffs on China, but the implementation could kind of ramp up over time.
So here's the latest this morning. Markets absolutely whipsawed by conflicting reports in the last 24 hours. The Washington Post suggesting Trump's aides are looking into tariffs that would only apply to critical imports. The president-elect Donald Trump quickly pushing back, saying the story, quote, incorrectly states that my tariff policy will be pared back. That is wrong. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, I guess the first question for you, what is actually going on?
Yeah, good morning, John. So President-elect Trump quick to dispute that Washington Post reporting. Whether or not that does result in universal tariffs once he takes office remains to be seen. But it's clear that he's pushing for universal applications. I took a look at his Truth Social post for this week alone, and it's only Tuesday, and a quarter of his posts mention the word tariff, whether he's talking about Canada, the Nippon steel deal, or perhaps where we're watching most closely here in Washington, using tariffs as a potential revenue raiser for his proposed reconciliation package. That could be in a bid to court Republicans who have time and time again told us on Capitol Hill that they're concerned about pay-fors for a potential Trump agenda and expected tax cuts. Of course, though, John, in none of these posts are concerns about any potential inflationary or retaliatory impacts, which is actually why I'm watching closely this month's consumer sentiment readings from the University of Michigan, which is a little more sensitive to politics, and how Americans are starting to internalize these potential economic impacts as we get closer and then ultimately start the Trump presidency this month.
Well, we're seeing the sausage making play out in real time on a number of issues with the incoming Trump administration. It's clear he wants optionality. Yesterday, when Trump was talking to Hugh Hewitt, he talked about the fact that maybe he would be even open to 2 reconciliation bills. And he's potentially going to be meeting with Republican senators. What's the big debate right now that's still brewing between the House and the Senate over how they pass his agenda?
Yeah, Anne-Marie, I was actually talking to one Republican strategist yesterday who's advocating for that two-bill approach to separate out the priorities when it comes to immigration and energy and then save the tax overhaul, that more prickly fight for later down the road so that way Republicans could notch some early wins. Now, we know that the Senate Majority Leader John Thune is more inclined to that two-bill approach because when you look at, as you refer to, the sausage making getting done, it's difficult to see how everything could be folded into one bill when there is so much disagreement. So instead, maybe separate out some of those priorities where we see a little bit more widespread support. But we should, this time next week, we should have a clearer picture of that because, as you mentioned, we are expecting Trump to meet with Senate Republicans. But then this weekend, he's invited a whole different cohort of House Republicans to Mar-a-Lago that all have different sort of fights in this reconciliation package, whether that's the House Freedom Caucus or members that represent districts impacted by the SALT deduction down to Mar-a-Lago so that they can start to hash out their differences.
I guess the question then comes to who wins? Who wins in this fight when it comes to how they decide they're going to implement his agenda?
Right. I think at the end of the day, President-elect Trump just wants an early win. And ultimately, he's going to go with the path that will get him that. As you mentioned, he signaled that he is opening the door to a potential two-path track if that's ultimately what it takes to get his agenda accomplished. We know that he wants to come out of the gate with some early wins to notch and then ultimately put forward some of perhaps these other policies that we are talking about when it comes to tariffs. But it's clear that he wants some of these tangible deliverables on the table first.
Yesterday, Fed Vice Chair for Supervision Michael Barr said that he was going to step down effective February 28th from his position, really overseeing a lot of the bank capital rules. Is this an early win for Donald Trump?
Right. So Michael Barr has long been a target, particularly of Senate Republicans. We know that incoming Senate Banking Chair Tim Scott yesterday put out a statement absolutely blasting him, blaming him for the 2023 regional bank crisis and also the capital rule requirements under the Basel III endgame proposals. And it was clear that he's been a target since he was appointed by President Biden in 2022. And Lisa, I can tell you, I was in the room when Jerome Powell said that Trump did not have the authority ultimately to fire a Fed governor. And you could hear a pin drop in that room. It was so resounding. But it appears that Barr wasn't up to, it appears Barr was looking to avoid that potential fight. But important to note, he stepped down as vice chair. That, of course, limits the options to replace him, particularly as Trump now has to look at the Fed governors to instead fill that role.
Right, which has led some people to talk about Mickey Bowman. The question, and you were tripping over it, whether he wasn't up for a fight or whether he thought the fight might not necessarily be good for the Fed. I actually don't blame you at all because this is actually a real key question for people. Do people think that this undermines the Fed? Or does it actually support it, edify it by allowing one of the current Fed governors to step in? How is it being perceived in Washington?
Right, particularly, and we have been watching closely, even on the campaign trail, how President-elect Trump was dealing with the Fed and this idea of Fed independence after he had previously said that he felt that the executive should actually have a role in these monetary policy decisions. And we had even heard floated this idea of a potential shadow Fed chair as a potential policy that could be implemented under an incoming Trump administration. Ultimately, though, when it comes down to it, Senate Republicans have all applauded this decision as widespread. And you mentioned, of course, Michelle Bowman now being floated to potentially fill that spot. She has long been considered a potential ally when it comes to this Republican nominee appointed during the first Trump administration.
Hey, Tyler, good to catch up. Tyler Kendall down in Washington, D.C. We'll catch up with French Hill of Arkansas later on this morning. The House Finance Committee chair had this to say following that resignation, Lisa. I was pleased to learn that Michael Barr is stepping down. A lot of Republicans share that view.
So in 2023, he was the person who really put forth a series of capital rules that elicited a ton of pushback from the financial industry, saying this would cripple banks or reduce lending. And his stepping down comes ahead of an administration that is absolutely going to wage war on all regulation of banks and try to deregulate the banking sector. It just goes to show that there is a very narrow line about whether there is a sort of a negative issue tied to fighting this president when it comes to Fed independence or whether it is the appropriate thing. And it is unclear about how it's perceived. It's clear where he weighted on this.
Congressman Hill joining us in about 50 minutes' time. Do not miss that conversation. Who remembers the family photo of the G7 in the south of Italy in the summer? And Anne-Marie was down there and she said, how many of these people are going to be left in 6 months? We'll count. Up next on the programme, Erik Nelson of Wells Fargo. Two-day winning streak on the S&P 500, leaving behind that 5-day losing streak to close out and begin 2025. Equities right now on the S&P 500 up by 0.1%. On the Nasdaq, up by 0.1% also. On the Russell, the small caps doing okay, up by 0.2%. Lots to talk about in the bond market, particularly at the longer end of the curve, and we can start from 30s and work our way in. The 30-year yield is up a single basis point in the US at 4.86, so close to levels we haven't seen since late 23. In the UK, close to levels we haven't seen since the late 1990s. Starting to look a little bit painful in British markets.
Especially when it's not accompanied by the growth that a lot of people are expecting in the United States. And it really produces this quagmire that, frankly, both the Bank of England and the ECB are facing, which is inflation is proving to be sticky, even at a time where they need to generate some growth and, frankly, might limit how much they can cut rates.
Sterling doing better this morning. Cable, the pound, doing better against the US dollar. In the last 24 hours, everything was doing better against the US dollar. Really, that was initiated by that report coming out of the Washington Post, suggesting that the incoming aides of President-elect Donald Trump were thinking about or proposing ideas that would water down a universal tariff. President-elect Donald Trump pushing back pretty quickly. But those moves hold, Lisa, and you made this point, euro-dollar at 104, which I think speaks to a lot of things, and one of them is positioning and how loaded the boat was to the one side going into that release.
I think that's the more important takeaway, because as we were talking about yesterday, we're going to get a lot of this whipsaw. A headline that says this, and then another tweet that says, or a truth posting that says it's not true. The point here is that there is a lot of hope that we can unlock a little dollar weakness and a little strength elsewhere. You see that also in some of the equity indexes over in Europe, the sort of hope that maybe all the pessimism has been priced in and just how little it will take to get some flows into the region.
Not much needs to go right to trigger a big move in the opposite direction when positioning is so lopsided like it has been building over the last month or so. That's euro-dollar 104.08. Under surveillance this morning, one of our top stories, NVIDIA CEO Jensen Huang unveiling new products during his keynote presentation at the CES trade show in Las Vegas. The lineup includes graphics cards for gaming PCs built on the company's Blackwell chips and software to help companies develop autonomous driving and robotics AI.
My favorite part of this is the future that he put out there of 1 billion robots and 10 million factories that are automated, and just the idea of our humanoid but not quite human future that also includes $1.5 billion of self-driving cars and trucks. The idea of where this application will go and the hope that it will happen soon, with him even name dropping some specific car companies who soon quickly got a boost in their equity shares. A question here of whether he can come through with this and whether NVIDIA is just showing why NVIDIA will be the biggest winner of this transformation and not that broadening out.
Well, they have the software component, they have the chip component, and now it feels like they're going to be pervasive everywhere. And it goes back to what Julian and Emanuel said at the start of the program, which is basically this is an inflection point this year for AI adoption and how we see it really circulate across consumers and everything consumers use.
And we've got the conversation that matters coming up on Bloomberg TV. Do not miss this. 11:30 Eastern Time on Bloomberg Television. Bloomberg's Ed Ludlow will be sitting down with Jensen Huang live from CES in Las Vegas. Must-watch TV a little bit later this morning. Elsewhere, the US blacklisting Tencent and CATL for alleged links to the Chinese military. Both companies pushing back, saying they have no ties with the military. The move threatening to disrupt the global EV market, with Tesla and other major automakers dependent on batteries made by CATL. Tencent came out and said this must be a mistake. We have no relationship whatsoever.
The issue is the fact that if you are a Chinese company, what U.S. officials will tell you is they have an obligation sometimes. If there's a national security concern, the CCP comes to you and says, we need to know about this, they have an obligation then to share that information with the CCP. I will say the incoming Secretary of State, Marco Rubio, talked about CATL in August. The fact that this is he was talking about this could potentially be a vital supplier to the PLA, and he wanted it to be put on this blacklist. I think you're going to see a lot of this. This list designates from Trump 1.0. The question I have is why the Biden administration waited for the last 2 weeks on their way out to decide to put these two names on it.
Yeah, especially after all the hacking news. I mean, let's just talk about how much, hundreds of government officials have been hacked into, people using now text and Signal to try to avoid CCP oversight in the United States. So there's a real question here about whether this is truly a tit for tat with China retaliating, or whether this is something more, where there suddenly is this broader recognition and an increasing decoupling of tech in the United States and in China.
Lisa, I'm glad you brought that up. We talked about yesterday how we all read this very detailed report from the Wall Street Journal over the weekend. The first line of that talks about Chinese hackers gaining the ability to shut down dozens of U.S. ports, power grids, and other infrastructure targets. Jake Sullivan told telecommunication technology executives at a secret meeting in the White House in the fall of 2023. So more than a year ago.
Kind of shocking. You think about the arc of policy coming out of this administration towards China. You have to go back a couple of years and remember that at one point they were considering taking tariffs off China because of the inflation fight, which is kind of amazing given that everything has happened reportedly since then over the past few years.
Right, because they were looking at any lever they can pull to try to bring inflation down, because this was the biggest issue Joe Biden had domestically. And one of them was going to be potentially, and this they oohed and ahed, it was a big Treasury versus national security concern debate for months. In the end, Joe Biden said, no, we're going to keep those tariffs on. But you're right. It was something they were looking at doing for months.
Tencent getting hammered off the back of all of this. Meta elsewhere, electing 3 new directors to the board, including Ultimate Fighting Championship CEO Dana White. White has been a vocal supporter of President-elect Donald Trump, speaking at the Republican National Convention and Trump's election night event.
This is just another one of the big tech companies that are adding more conservative members to their boards. This does come after Mark Zuckerberg does have a relationship with Dana White going back, so it's not completely out of the blue. You should note that. At the same time, it kind of speaks to the point you're making earlier, which is companies are adapting and adjusting to this new political regime, and they're doing so at a very quick pace.
They're adapting to the fact that the election showed this is a center-right country at the end of the day. And it's not just Dana White, which when I view him, I just remember Trump being at the RNC talking about the fact that he decided to leave his vacation early to come here personally and introduce Trump. Not Melania Trump, Dana White introduced Trump at the RNC. So when you think of him, you do think of the Trump world. But also, Nick Clegg is out. You guys talked about this last week.
Yep.
Joel Kaplan, deep Republican ties, is now the man that has to deal with policy.
Watch this space. It's not the first, not the last. The winds of change. We're going to see a whole lot more of this through 2025 and maybe even beyond. Let's turn to Canada. Prime Minister Justin Trudeau resigning as head of the Liberal Party after more than 9 years in power.
I have always been driven by my love for Canada, and Canadians deserve a real choice in the next election. And it has become obvious to me with the internal battles that I cannot be the one to carry the Liberal standard into the next election.
And given where the polls are right now, 20 points behind the Conservatives, that choice might turn out to be a big change. And that has been a major change. Go back to the G7 photo in the south of Italy 6, 7, 8 months ago. Anne-Marie, you were down there. How much that's changed in the last 6 months, half a year?
We talked about it. I was reporting live from Bari that this was a lame duck lineup of leaders, except for one. Giorgia Meloni, who basically greeted everyone. It felt like they were all going there to kiss the ring in southern Italy of this new leader of Europe, this Principess of Europe. Yeah, Emmanuel Macron's there, but he has been dealt a huge blow domestically. She's really the only one left in this list of leaders.
We've seen reports that Governor Carney may be interested in throwing his hat into the ring. Of course, Governor Carney is the chairman of Bloomberg Inc. We should recognise that. I would say this, though, for anyone looking to throw their hat into the ring here, you're 20 points behind the Conservative. Why would you want to get in now? Wouldn't you just wait, have the election, watch them fail, and then jump in?
This sort of goes to the question of how much the U.S. is a template, showing what you should do and what you shouldn't do. And maybe Justin Trudeau is trying to get out early to avoid a Kamala Harris, Biden kind of situation where you get out at the very end and you don't leave as much time to a potential candidate. But you're right. How big of a gap can you possibly close when you do have momentum on such a level on the Conservative side?
Erik Nelson of Wells Fargo joins us now to talk about potential market implications. Erik, welcome to the programme. There has been a clear and obvious shift against incumbents and in many cases towards Conservative leaders. Erik, what do you think the market consequences of all of that are going to be?
Yeah, John, who would have guessed that Italy would be the bastion of political stability in the G7? That was certainly not expected, but yeah, it's obviously a lot of forces domestically in all these countries, whether it's immigration, inflation, driving that. I think it really depends on the country, right? You look at Germany, I think there's some positive forces and sort of catalysts that could come out of the election in February, right? Potential changes to the debt brake. Germany has been a beleaguered economy for several years now, underperforming most in Europe. So I think there actually could be some positive catalysts there. You look at a place like France, maybe a little bit less so. There's still a lot of consternation and it could be messy if there's another election this summer. Canada, though, this is all about tariffs, in my opinion. Domestic policy in Canada is not really moving the currency markets all that much. Question is, how fast does Poilievre come into power? How fast can he get into these tariff negotiations? Fortunately, though, I'll say, Trudeau, I'd say, sent some positive signals after his visit to Mar-a-Lago at the end of last year. I think Canada, on the whole, can avoid the worst of the tariff sort of issues and implementation, but it's going to be a rough ride for the next few months here.
Erik, I just want to underscore something you said. Essentially, it doesn't matter who comes, who goes, the leadership of any of these countries. What matters is tariffs, in terms of just where the currency is, and that has been the reason behind the loonie strengthening over the past couple of days, as well as the euro. Is that correct?
In the case of Canada, absolutely. Again, I don't see any real material change in domestic economic policy, maybe some slight fiscal tightening from the Conservatives in Canada if they come into power. I think Germany is a different story. Tariffs matter hugely, but so too does domestic policy, right? We know the German economy has lagged for a long time. They need debt brake reform. They need to unlock some of that fiscal spending. I think Merz is the kind of candidate that can deliver that. The question is, does he have the backing, right? Does he have that supermajority in the Bundestag to really deliver that? And that's what we'll have to find out at the end of February.
There's also this sort of question around Europe, which is how do you pair tariffs with the idea that inflation is sticky and might limit how much the ECB can cut rates? How do you sort of juggle those two ideas?
I think tariffs themselves are probably not inflationary to the extent they're going to move the needle on ECB policy. If anything, they're probably demand negative. We know Germany in particular, very manufacturing export dependent. But if you look even pre-tariffs, just the last few weeks, some of these inflation prints we've been getting out of Europe have been a little bit hotter, right? You look at the just this morning, the ECB inflation expectations figures, pretty strong. And German inflation numbers yesterday also on the hot side. So we're coming into this with a little bit of actually fresh momentum in European inflation. That's going to make the ECB's job more difficult. And one reason why we think that sort of front end, short end rates in Europe and Germany have some room to recover here alongside the euro.
Erik, what did you make of the whiplash we saw yesterday with the Washington Post story talking about how this might be a more narrow, targeted approach on critical imports into the United States, and then Donald Trump walking that completely back? When you see that episode, really on one of the first big trading days when people are back from the holidays, what did you learn from that potentially you're going to be looking out for the rest of 2025?
We saw this just time and time again in 2017 and 18. And I think my takeaway is there's some kernel of truth to the story. I think there probably is an initiative being worked on by the likes of Besant, Lutnick on this sort of initiative. I don't know that it's the only initiative, right? There's still the U.S.-China piece, which I think is really its own track for tariffs that wasn't really mentioned as part of this story. I suspect that is something that's being worked on in parallel. There's a lot of Section 232, Section 301. I think it's going to be a multifaceted approach on tariffs this year. I think Trump's denial is not necessarily that surprising, right? You don't want to necessarily signal, hey, actually, all that tough talk I had on the election campaign, it was really just bluster, right? You don't want to send that message. So I think there is a kernel of truth to this. I do think that, our baseline is that we're not going to get 20% tariffs on all countries, on all goods, right? I don't see that happening. I think what it really reveals, and you were talking about this earlier, is positioning, right? You just needed one headline to get a little bit of relief in this dollar strength trade. I think it's going to be a very back and forth year for the dollar. We're still bulls on the dollar, but I realize short term we could see a little bit more consolidation and some dollar weakness next few weeks.
If we could just build on that kernel of truth and coming back to Canada where John started the conversation, if it was to be critical imports, what would that mean for Canada?
Well, Canada is a big exporter of iron and steel to the U.S., so if this is going to be via Section 232, sort of a national security route for tariffs, yeah, Canada is going to be certainly in the crosshairs. It's not, at the end of the day, energy is really what Canada tends to export to the U.S. primarily, right? So as long as that's not included, Canada is going to avoid the worst of this. There's also some sort of off-ramps, some side letters in the USMCA agreement that actually allow for some delay in tariff implementation between the U.S. and Canada. So that's also sort of working in Canada's favor here and potentially helping to at least delay or at least maybe ideally allay some of the biggest concerns from U.S. putting tariffs on Canada.
Erik, good to see you. Great to catch up. Erik Nelson there of Wells Fargo on the latest and the changing face of the G7 in the past 6 months or so. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. Sticking with President-elect Donald Trump, he is looking to keep the special counsel's report against him from becoming public. Trump's lawyers are arguing that the report should not be released, citing Jack Smith's political motivation and desire to undermine the transition. Smith had dropped his case against Trump after the election, citing long-standing DOJ policy against prosecuting sitting presidents. Getty Images and Shutterstock have announced that they will combine in an equals transaction merger. The combined company will have an enterprise value of about $3.7 billion. Once the merger is finished, the company will be named Getty Images Holdings and continue to trade under the ticker GETY. Shares of both companies, as you can see, are much higher in the pre-market. Home prices in the UK have dropped for the first time in 9 months. Average prices fell 0.2% in December to just over $370,000 US. They had climbed to a record high last summer. The drop in prices is attributed to stuttering economic growth and high mortgage rates, which are expected to continue to pressure the housing market. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next, the Fed's fight against inflation.
I think the bigger risk is reacceleration, not only of inflation, but of the economy, too. All of this is just suggesting that the acceleration story is going to be the bigger issue.
Apollo's Torsten Slok up next. Two-day rally on the S&P 500. Can we make it day 3? Equities just about positive on the S&P. Under surveillance this morning, the Fed's fight against inflation.
I think the bigger risk is reacceleration, not only of inflation, but of the economy, too. Add into that the inflation rate is not getting to 2%. There is an argument to be made that it is stalling at around, the high 2s if you measure it by CPI. Because we're at the same levels on year-over-year CPI that we were 7 months ago. And all of this is just suggesting that the acceleration story is going to be the bigger issue.
So here's the latest this morning. The US 30-year bond yield climbing to its highest level in more than a year as investors remain concerned over a potential reacceleration of inflation. Torsten Slok of Apollo noted the impact of the Fed cutting 100 basis points, writing the bottom line is that Fed cuts and associated developments in financial markets will boost GDP over the coming quarters by 1 percentage point and boost inflation by 0.5. Torsten joins us now for more. Torsten, good morning.
Morning.
It's good to see you, sir, and a happy new year. You wrote, and I think it's important to recognise, they cut 100 basis points in September, and yields moved 100 basis points in the other direction. What do you think explains that?
Well, that is really unusual. I mean, normally the textbook would say if you cut interest rates, long rates should also be going down. So why is it that when they have cut 100 basis points in September, that we've now seen long rates go up 100 basis points in September? And that's opened up a lot of conversations about, is this because Fed cuts were not warranted? Is that because of fiscal policy? Or is it because of less demand from abroad? There's just a very important quantification debate around why is it long rates are going up. And an important part of that question is that the term premium has gone up 80 basis points, at least according to the New York Fed. So using that measure, 80% of the increase in long rates since September has potentially been driven by worries about fiscal policy, at least issues that are not explained by changing Fed expectations.
So which of the 3 questions, which of the 3 points that you're making do you lean on as a reason behind the rise in yields?
Well, the challenge is when you do these decompositions and trying to quantify what are the sources of why long rates are going up, is that you don't know this unexplained factor in the term premium, what's driving that. Is that because of fiscal worries? Is it because of, some people say it's just some technical issues with the yield curve steepening? In my view, I think at least it tells you that there's something else going on, because if you look at the chart, it is just really unusual that long rates are going up when the Fed is cutting. So that's why, if it is because the market is worried about fiscal issues, then of course we need to think about, well, what are the consequences as we get some fiscal news potentially over the next several weeks.
A number of people have said this is a good thing and people should embrace it. You see an actual normalization of the yield curve, and that's fantastic. You have a newly positive yield curve, 2 10s now, the steepest going back to 2022. 2022. Do you think that it is a positive development or a negative development?
Well, I think what's lying underneath this is that the expectation was that, when the Fed starts cutting, they always cut a lot. And of course, over the last several quarters, the expectation was that the Fed will cut a lot more relative to what's priced in at the moment. So now, of course, markets are pricing that rates will stay higher for longer, and therefore we will not get all these cuts. So the question, therefore, is, well, is that good or bad news? Well, it's good in the sense that the backdrop is that the economy is still strong. But the bad news, of course, is that rates higher for longer will continue to weigh, in particular, on balance sheets that are weaker. Companies with a lot of leverage, companies with low coverage ratios will continue to get hit by rates higher for longer. So higher for longer has a number of consequences that are bringing back memories of what we saw in 2022 when you had rates going up and stocks going down at the same time.
With yields higher over the past since the Fed has been cutting, and you're saying some of this is driven by fiscal, we haven't gotten the fiscal package yet. But the incoming Trump administration has made it clear in the first 100 days they want to see something, whether or not it's one reconciliation bill or two. So basically, is that just saying to the Fed, you're on pause until we see exactly what comes out of this proposal?
Well, and I think also to your important point here that it used to be that these bills would be two separate bills, one with border and security in the first bill that will be dealt with first, and then later we'll deal with what's going on the tax front. But combining all this, of course, raises the risk that I'll get a Bloomberg headline saying some pretty significant number in terms of what the deficit impact is. So if you do have a bigger risk of a higher headline number, that also raises at least modestly the probability that we'll get some at least potential distrust moment where we could see a fairly significant number coming out, where instead of doing it dripwise throughout the year, having a big number where suddenly markets say, wow, there's already QT going on, there's a stock of T-bills that need to be rolled over, and on top of that, we already have a 6-7% budget deficit. All that combined means that Treasury issuance continues to be a very important topic.
What does that Liz Truss moment look like in the United States?
Well, the risk, of course, is that if there is a still very significant budget deficit, and if we still have significant issues with, again, the number of T-bills outstanding, meaning short-dated debt that needs to be rolled over, we still have QT. There's a lot of conversations about when that potentially will end. And on top of that, if we do have new fiscal deficit spending and a number that's much bigger than what the market is expecting, that certainly raises the probability, at least, that we might have some situation where the markets are saying, wow, that's a lot of Treasury issuance. We already have discussions literally every day when we have a Treasury auction around, hey, what was the metrics on the auctions and what are these numbers telling us in terms of the overall fiscal sustainability, which Jay Powell, of course, always keeps on pointing out is already unsustainable.
Lisa mentioned it already this morning. We get a 10-year a little bit later. You wrote about it to close out 24. The risk of a 2022 repeat in the market, how great is that risk?
I think that is much higher than what the market is the probability the market is assigning at the moment. Because remember, the key issue in 2022 was that the 60-40 portfolio really underperformed because rates went up, because inflation was going up, and at the same time stocks went down. And now we've had the Nike swoosh has been flattened out on Fed expectations. So therefore, if we now are getting back to Fed expectations being roughly flat, we have a few cuts priced in. Imagine if suddenly those expectations start to move up, that people are saying, well, maybe we'll get another hike. I do think a lot of equity investors will be looking at that and saying, well, in that case, you already had the trailing PE on Tesla at almost 200. That's why some of these stocks on a trailing PE basis are incredibly expensive. And if you now have that, well, maybe the Fed has to do something more, meaning hike rates again, well, then I do think some of these more sensitive names, they will certainly see a bigger hit. So that's why, given all the stocks returns have been driven by a handful of stocks, I do think that that makes it much more sensitive to if, again, the Nike sweeps up and we do get a situation where the Fed is pricing in more hikes coming.
Torsten, a clinic, as always. It's good to see you, sir.
Thank you.
Thank you. Torsten Slok there of Apollo. In a second hour of Bloomberg Surveillance, just around the corner, we'll catch up with Keith Lerner of Truist, Republican Congressman French Hill, Jason Thomas of Carlyle, and former Chicago Fed President Charles Evans from New York. This is Bloomberg.
We ended the year on a bumpy note. We sort of started the year on a bumpy note because we know that we need more clarity. We need more answers.
One of my core beliefs about politics and markets, whatever it is, you have to go through some temporary repricings.
We are at levels that are problematic for the stock market.
We'd expect another strong year, just not to the same extent of 2023 or 2024.
I think we're seeing probably more opportunities in the equity market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Bouncing back from the longest losing run since April. Two-day winning streak on the S&P 500. The second hour of Bloomberg Surveillance starts right now with equity futures up by about 0.1% on the S&P, just about unchanged on the Nasdaq 100. Loads of economic data this week, including payrolls on Friday. Later on this morning, JOLTS job openings, the ADP and claims report you will get tomorrow. Bear in mind, jobless claims usually comes on Thursday, but we've got the late President Jimmy Carter's funeral on Thursday, so claims are brought forward. And also keep one eye, maybe two eyes, on the debt auctions coming a little bit later. Lisa very focused on this. 10-year notes later on and 30-year bonds tomorrow.
Yeah, $39 billion of 10-year notes today at 1 p.m., $22 billion tomorrow of 30-year notes. And yesterday's 3-year auction didn't go phenomenally. And we should note that usually shorter dated paper does better. If you are having your eyes glaze over as you listen to this and you're saying, really, this again? This is incredibly important at a time where yields on the long end have backed up dramatically, and you see them much higher than the ones in the short end, the highest levels that we've seen going back to 2022, which really has a huge impact on all financial instruments.
Garfield Reynolds, a market strategist at Bloomberg, was talking about how bond investors may face a lose-lose dynamic coming out of Washington. Well, actually, this week, I'm also looking forward to this reporting that President-elect Trump will be sitting down with Republican senators. We just talked about this with Torsten Slok about how they may see maybe one huge reconciliation package. The bond market might find that very uneasy, and it might unnerve them. Maybe they would need to do two, and potentially these senators can assuage him.
And not just the US bond market, but the global bond market. What happens here is going to put the fiscal squeeze on everybody else abroad. I think the headline that we got out of the UK this morning is pretty clear on that fact, that we've got a UK 30-year yield at a high we haven't seen since the late 1990s. And that's certainly not about growth, and that was your point in the last hour. That's about something else.
It's about debt auctions in the UK. It's about U.S. rates, and it's about the fact that inflation has remained stickier across Europe, across the U.S. It raises a question. Are we in a secular inflationary environment that is going to make it very difficult to see rates come down to levels that a lot of these countries need in order to get the growth that they want? And that is the reason why people are trying to answer the question that Torsten Slok was just asking. Why? Why the incredible rise, and how sticky is this?
They've lost fiscal space in the UK. They've lost fiscal space in France. And if the United States comes out with increased debt and deficit spending, they're going to put the squeeze on these countries even more. So what does it mean for markets? Well, Torsten Slok of Apollo is making the case that maybe a big risk for this year is a repeat of 2022. Bad for bonds, bad for stocks. Bad for both.
Well, this is the reason why people are sort of wondering, what regime are we in? And we go back to what Stuart Kaiser was talking about, 2017 or 2018. If you have a situation where the prospect of another Fed rate hike could come back on the table, how much could that torpedo already elevated equity valuations at a time where people still have not wrapped around their heads what the idea of higher for longer actually means for risk assets?
The problem with that is that President-elect Trump is not going to accept a market that's bad for bonds and a market that's bad for stocks, which may mean that might be the ultimate check on what he does in power.
3 minutes of market coverage for the bears. That's enough of that. Equity futures right now on the S&P 500. That was so negative to start this hour. Equity futures on the S&P just about positive. On the Nasdaq 100, we're doing okay, just about unchanged.
Can I just add some positivity?
Please do.
Okay, maybe yields are higher because growth is actually going to do really well. And we're going to get the efficiency from the godfather of AI, Jensen Huang, and his rock star jacket, and he's going to come out and transform the way that we live.
It's a nice bullish story to help you sleep at night. Coming up this hour, Keith Lerner of Truist, as stocks look for a third straight day of gains. I would not let you narrate my stories to sleep at night. Congressman French Hill on President-elect Donald Trump's agenda, and former Chicago Fed President Charles Evans on the Fed's timeline for a return to 2%. We begin this hour with stocks higher. The S&P 500 and the Nasdaq seeing back-to-back gains as investors begin to pile back into big tech. Keith Lerner of Truist cautiously optimistic, writing the primary market trends remain higher, driven by a resilient economy, supporting solid earnings growth near 10% in 25, yet investors should anticipate a bumpier path relative to last year. Keith joins us now for more. Keith, welcome to the program, sir. Why a bumpier path this year compared to 24?
Yeah, well, great to be with you. Our outlook theme is a bull in a China shop. So kind of as you mentioned, the primary trend is up, but it's going to be delicate. There's going to be some things that are likely broken. I think what we look at, the November pop in the market, then followed by the December pullback, is kind of a microcosm of what to expect. I think one thing, just as a starting point, as far as why it might be a pumpier ride, is expectations, right? Expectations are much higher this year, and markets are all about how things come in relative to expectations. You have to remember, coming into last year, the consensus was looking for GDP growth for the U.S. economy around 1%. It looks like that's going to be around 2.5% for 2024. As we move into this year, we already have those expectations that are somewhat higher. And then, of course, the battle that we all know between the potential good and the potential bad of Trump's policies.
And Keith, why you should have maybe a little allocation to gold in the portfolio. Keith, why does that make sense this time around?
Well, it's just something that's as somewhat of a portfolio diversifier as a whole, and also kind of the geopolitical uncertainty that we're seeing. Central banks are continuing to buy gold. In fact, we just saw a headline this morning from Bloomberg about China continue to start buying gold again. So we just think that's a good hedge relative to just a stock and bond portfolio.
Keith, the fact that you even want to hedge to the stock and bond portfolio is interesting, especially in light of our conversation just moments ago with Torsten Slok of Apollo. The idea that maybe we could see a repeat of 2022 when both bonds and stocks did poorly, simply because you might have some sort of reemergence of inflation that could prompt the Fed to hike rates. Is that on your bingo card at all for 2025?
Well, it's certainly a risk. We don't think it's the most likely scenario, but I think this, if you look back over the last 18 months or so, when we've seen rates move above 4% and move at a quick velocity, that's been the struggle for the market. It's not just getting above 4 or 4.5%, it's the pace at which we've moved. And if you look at the bond market, which you all have been talking about this morning, really to us, the main reason for the recent move up is you're seeing that term premium, that uncertainty factor really start to rise at a more rapid pace. So I do think that is the risk, but I would also say it probably has to reset on how people think about investing. Now, part of the reason back to tech is because of this, because if you think about small caps as an example, where a lot of people got more positive after the election, they're basically back to where they were pre-election because those interest rates are somewhat higher. So if rates are going to be somewhat higher for longer, which we think is the case, it's going to be hard for something like small caps, which have a lot of floating rate debt, to outperform. And we've been bullish tech all last year in communications, and we're still bullish now. Just an interesting tidbit, not a recommendation, but NVIDIA peaked in June of last year. It was actually flat, or actually slightly negative from mid-June to the end of last year. Semiconductors are still about 7 or 8% below the lows from July. So even though we've had this kind of ramp up recently, we still think there's further to go in tech.
I'm glad that you mentioned this, because so far to start 2025, we've seen this effort to have stocks climb out of a hole that was at the end of the year, but it really has been only big tech. That's been the outperformance. You've seen an underperformance of equal weight, underperformance of small caps. To your point, is that basically the roadmap for the year ahead, with people betting on 1 billion humanoid robots from Jensen Huang?
I would stick with tech as the primary or the dominant theme of this bull market. When we look back at bull markets, every bull market tends to have a theme. This one, as we know, is AI. And when you look back at the late 90s bull market, like tech led until the end as far as relative performance. As you move to the 2000s, it was more about global industrialization. We saw things like EM and industrials lead to the end. So if you believe the bull market is intact, which we do, then it's more likely that AI will and technology will continue to lead. And when that stops, it probably means that we're the end of this bull market. Again, we're giving it the benefit of the doubt. I will say underneath the surface, you're looking at, only about 25% of stocks in the S&P above the 50-day moving average. So just that does kind of go to your point about it. It's really been more tech. I would say we like tech. We like large caps the most. After large caps, it would be mid caps and then small caps the least within the U.S. But I also think this backdrop still continues to support our longstanding bias for the U.S., which has a lot more tech in the large cap index.
I know your bias is to the U.S., but you also talk about how international market underperformance is at an extreme. And when it's at an extreme, like we saw with positioning yesterday and all those tariff headlines, you can take advantage of it. Are there any areas that you think we should be looking out for that potentially the market could take advantage of?
Yeah, well, since we've been on the U.S. side for several years, I know that becomes a really big consensus heading into this year. So you always start to think, okay, where could the consensus get tripped up a bit? And it is extreme. We just had the worst performance of developed international relative to the U.S. since 1997. And then when we look back at 2016 as a little bit of a roadmap, we saw international underperform initially, and then in 2017, for a couple of months, they outperformed. So I think the risk is you could see a kind of a cyclical rebound, or maybe a short-term rebound, but I still think the fundamentals favor the U.S. So unless you're very nimble, I still think you want to stick with the primary outperformance of the U.S., which we expect to continue. Especially if you expect tech to outperform, then inherently you're still saying the U.S. and large caps should outperform because of the weighting within the indices themselves.
Hey, Keith, got some breaking news on a large cap right now we need to talk about. Good to catch up. Keith Lerner of Truist. That name is Meta. Of course, you saw the change in the past week. Nick Clegg is out, coming in, taking over. Joel Kaplan, the Meta Chief Global Affairs Officer, out with this statement this morning. And here's some of the headlines for you. Starting in the United States, we are ending our third-party fact-checking program and moving to a community notes model. We will allow more speech by lifting restrictions on some topics that are part of mainstream discourse and focusing our enforcement on illegal and high-severity violations. We would take a more personalized approach to political content so that people who want to see more of it in their feeds can.
This is a huge reversal from some of the moderation that they had in prior election cycles and, frankly, prior years. This, according to Mark Zuckerberg, some people believe giving more people a voice is driving division rather than bringing us together. More people across the spectrum believe that achieving the political outcomes they think matters is more important than every person having a voice. I think that's dangerous. This idea of the Dojification of Meta at a time when potentially, whether they're catering to this new administration or adopting what basically has been the shifting sands, it remains a debate.
It feels like Joe Kaplan and Dana White are officially in the driver's seat now when it comes to Meta. We want to fix that and return to the fundamental commitment to free expression. Sounds like something you would hear from Elon Musk when it comes to X.
Big changes at Meta and more big changes still to come, I'm sure, for corporate America. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. The Wall Street Journal reporting this morning that the Biden administration is in negotiations with the Taliban to swap Americans detained in Afghanistan for at least one prisoner, an alleged Osama bin Laden associate in Guantanamo Bay. The Taliban is seeking an additional 2 prisoners in exchange for the Americans. President Biden has reportedly not made a decision on the proposal yet. Hedge fund Bridgewater Associates has laid off about 7% of its workforce, affecting about 90 employees. A spokesperson for the firm said that the layoffs are meant to keep the organization nimble and flexible. The cuts now bring the firm's headcount back to where it was in 2013. Similarly, hedge funds Two Sigma and Brevan Howard also cut about 10% of their staff last year. A patient in Louisiana who tested positive for bird flu has died in the first confirmed death linked to the respiratory virus in the U.S. The patient was over the age of 66 and had underlying medical conditions. Louisiana's Department of Health said that there were no additional cases found and no evidence of human-to-human transmission. The CDC says that there are currently 66 confirmed cases of bird flu in the country. That's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, Trump returning to Washington.
If I'm Donald Trump, if I'm chief of staff to Donald Trump, why do I care if it's one bill or two? How do I get what I want? How do I get my agenda approved?
We'll talk about that next on the program with Congressman French Hill. If you are just tuning in, welcome to the program. Stocks are positive on the S&P 500. A kick-off Tuesday morning, up by close to 0.1%. Under surveillance this morning, Trump returning to Washington.
If I'm Donald Trump, if I'm chief of staff to Donald Trump, why do I care if it's one bill or two? How do I get what I want? How do I get my agenda approved? If you tell me I get a better chance of doing that with one bill, yay, let's do one bill. If it's got to be 16 different bills, I'll do that. Historically in Washington, D.C., the reason you get these massive bills that everybody says they hate is that that's what passes.
So here's the latest this morning. Donald Trump heading to Capitol Hill tomorrow as the president-elect pushes Republicans to pass a single massive bill containing his priorities. Trump looking to secure a House vote on immigration, energy, and extension of the 2017 Trump tax cuts by April. The Republican Congressman French Hill of Arkansas joins us now for more. Congressman Hill, good to catch up with you as always, sir. We'd love your opinion on what you think is the best way to pursue the president's agenda. Is it through going after just one big bill?
Well, Jonathan, it's great to be with you. Yes, I do support one bill because I think that's the easiest way to get the votes for the president's priorities in the House, which include, as you said, energy permitting reform, securing the border, and of course, debating and completing an extension of the Trump tax cuts from 2017.
Congressman, we've been debating around this table how much the 10-year yield has a seat at the table when deciding what kind of bill and how big it is when the Congress meets and possibly passes this as soon as April. What's your view on this? How much of a veto power does the bond market have?
Well, Lisa, look, I don't think it makes any difference on that point, whether it's one bill or three bills, to the point of your previous commentator. What I think's concerning to me is that I wish we'd finished FY25 spending last Congress. I think that would have been in the president's best interest. But instead, this first quarter, we're going to do both. We're going to complete fiscal 25 spending by the middle of March, and we're going to try to do budget reconciliation with the House and Senate before early April. That's a big lift, and it may demonstrate a little uncertainty on the part of the bond market, but I think the real issue is let's get spending under control through budget reconciliation. That's the purpose of budget reconciliation. It's a procedure by which you can do big things in Congress using 51% vote margins in the House and Senate. President Obama used it to create Obamacare. President Trump in his first term used that to reform the tax code. So Republicans in the House and Senate this year want to use budget reconciliation to get federal spending under control while we also extend the pro-growth features of the Trump tax cuts.
Congressman, one of the concerns that we hear from a lot of fixed income strategists who come on the show is that they're not seeing where the cuts are going to come into place in this reconciliation bill. Where are they going to come?
Well, we had a meeting all weekend where we worked with our committees of jurisdiction on determining cuts in spending across the board, with the exceptions of what President Trump has taken off the board, which would be Medicare and Social Security benefit areas. The rest of it's on track. And you know how much spending has gone up, and just since the pandemic, we're running a $2 trillion deficit per year, 7% of GDP. That's the part that's unsustainable. Everyone in Congress knows that. So we've got to get our spending on a more sustainable, predictable front. I think that would benefit the bond market if they saw that kind of work on the part of Congress.
Well, we have the CBO talking about at least one point of that one big, beautiful reconciliation potential bill, which would be just extending TCJA over the upcoming decade would cost $4 trillion. On top of that, the president-elect continues to talk about no tax on tips. How much do you think can actually get through this Congress?
Well, look, Anne-Marie, you had CBO also say that the Tax Cuts and Jobs Act, when they did not dynamically score it, would not produce increased revenues over a 10-year budget window. And in fact, since 2017, you've seen record federal revenue pour into the country from no more reversions, people bringing taxable income back, the investments that were made, GDP growth, job growth, wage growth was all up in those years following the Tax Cuts and Jobs Act, but before the impact of the pandemic. So I don't believe House Republicans are governed completely by the opinions of CBO exclusively, even though that's an incredibly important component, because we've seen how in error estimates are from the Joint Tax Committee and from CBO, not recently, but for the past 50 years.
Congressman, you're also now the chair of a very powerful committee, the House Financial Services Committee, and we see a number of representatives going to Mar-a-Lago this upcoming weekend. Will you be there? And if so, what do you plan to discuss with President-elect Trump?
Well, President Trump has invited the committee chairs to a dinner, and we'll be talking about our priorities that we have for the first few months of his administration and getting his views on those.
What are your priorities? Specifically for the Financial Services Committee?
Well, you know, we've talked about that many times. I've got three big priorities. First, I want to right-size the regulatory system for particularly community banks. I think that's an important feature that's gotten off track, particularly in the Biden-Harris administration. We want to make sure the SEC is focused on capital formation and investor protection and orderly markets, and not a political agenda that soon-to-be former Chairman Gary Gensler had. And finally, we want to have a market structure for innovation in this country where people can use blockchain, can use digital currencies and digital assets to advance their business mission and make sure that the U.S. is a leader around the world in this new Web3 innovative technology.
Congressman, we also need to talk about the Fed. Yesterday, Michael Barr stepping down, you welcomed that. This morning, the Wall Street Journal in an editorial is talking about that maybe a replacement for Michael Barr will meet Governor Bowman. Would you welcome that?
Mickey Bowman's done an outstanding job as a governor on the Federal Reserve. She comes to the Federal Reserve with practical experience, both as a bank commissioner in Kansas, as well as a family connected to community banking business there in the heartland. She's been a great voice for common sense and tailoring and regulation. And I think she would be, if President Trump made that decision, that would be, in my view, a good one.
Congressman, we're seeing some big shifts in corporate America as well. We'd love your thoughts just to close up this conversation on what we just heard from Meta moments ago. And if you missed it, because it only broke about 15 minutes ago, I'll give you a summary of it. This came from Meta about 15 minutes ago, that starting in the United States, they're going to be ending their third-party fact-checking program and move to a community notes model, something we're more familiar with the likes of X. We're seeing some big shifts around corporate America. I think taking note of more conservative voices in the last few months, particularly after the election in early November. That is notable, I think, Congressman Hill, for corporate America. And I just wonder how you're responding to things and what you think of that shift.
Well, Jonathan, over the decade that I've been in Congress, for basically 3 decades before that, I was in corporate America, both with public companies and private companies. And I've never been a big fan for bringing politics, partisanship, and social policy fads into the corporate boardroom. I think business should be in the business of delivering a product that meets the needs of consumers, all consumers, no matter what their walk in life is. And so that's why I think it's good that business appears to be getting back focused on conducting their mission and leave the politics at home or out with their friends.
French Hill, appreciate your time, sir. Congressman French Hill
good to be
of
with
Arkansas.
You,
good to see you, sir, as always, down in Washington, D.C. Just finishing up there on some of the changes we're seeing in corporate America.
A question about what kind of role they're taking, how much this is shifting to conservative versus just simply exiting the stage left. I want to make a note, though, just to build on what you're talking about with that announcement from Meta, from Mark Zuckerberg. They talked specifically about their efforts in 2016 to have third-party moderators. And why it failed was because those independent moderators were no longer independent and actually had their own views and biases. It was almost a walking back of what happened following the 2016 election.
And it's really not a surprise given post the election and all these executives that have been going down to Mar-a-Lago speaking to President-elect Trump. I was putting together a list of the shift we've seen in all these companies.
Sure.
McDonald's yesterday, Meta yesterday, and today, Walmart, Tractor Supply, John Deere, other companies as well, Ford, Caterpillar, Boeing, and the list, I think, will continue.
Everyone wants politics out of corporate America. Everyone I talk to, anyway, and maybe that's just my crowd. I'll say this, though. Are we really taking politics out of corporate America or just replacing it with a different kind of politics? Because there's a difference. I have to say there's a real difference. And the way that Congressman Hill was talking about was just getting back to the old way of doing things. Get the politics out of the boardroom, get the politics out of corporate America, get the politics out of human resource departments as well. Do all of that. I'm on board with that. Most people are. But are we just replacing it with a different kind of politics?
It's a great question. And we don't know. I mean, honestly, we just don't know the answer. That will have to be ready to be seen. Also, how do you define what politics is when a lot of it has to come down to policies that go to the heart of how business operates? So it's kind of a very narrow line.
This is a huge story for corporate America and will be for the next several years. Coming up, Jason Thomas of Carlyle on the Fed's definition of restrictive monetary policy. That's next. This is Bloomberg. Equity futures right now on the S&P still just about positive, up by close to 0.1%. We're 2 hours away until the cash open with your morning movers. Here's Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. Las Vegas had something for everybody, from the jacket that Jensen Huang wore through to the sprinkling and the halo effect in terms of the companies that he's doing business with. The stock was up aggressively so far this year, up 11%, and it's the scale of adoption of Blackwell. Blackwell and Engine AI has arrived for PC gamers, developers, and creatives. This was about talking about robots, a business worth $38 billion is the projection. Hardware, $3,000 hardware PC for AI developers out there. So this is about encroaching more into autos, more into robotics, and really there was a sprinkling of dust for everybody. Uber got a little bit of the halo effect because Yesterday, 24 hours ago, I was talking to you about the upbeat guidance from Uber along with the buyback. NVIDIA and Uber. The data from Uber will lock into NVIDIA and give you the road forward, as Dara Khosrowshahi says, to supercharge the timeline for safe and scalable autonomous driving. So there really was a drop the mic moment for a number of different companies. Let's run it off with Tesla. It's interesting, they're on the back foot this morning. Bank of America downgrades the stock. Why? Because it's a valuation and execution risk. They do shift the price target to $490 from $400. So that's a genuflection to the valuation. But robotaxi now accounts for over 50% of the implied valuation in this stock. And therein lies the point. Where is the future of autonomous driving? How much of Tesla is really about the cars? We've talked about this with Dan Ives. That's about 15-20%. The rest is on autonomous driving and the AI trade. So for now, the Bank of America just takes 2% out of Tesla in the first wave this morning. Jonathan.
Manus Cranny, thank you, sir. Appreciate the update. We'll touch base again in about 60 minutes' time. And the surveillance this morning, US East Coast dock workers and their union meeting today to try to negotiate a new labour deal. If they don't come to an agreement, a January 15th strike that would shut up major East and Gulf Coast ports is all but certain.
So, new year, same problem, and potentially you can have 47,000 workers at these major ports striking as soon as next week. Interesting, though, early October, the International Longshoremen's Association got backing from high-profile backing, at the end of last year in December, from President-elect Donald Trump. And he almost was taking their side when it comes to automation. And at the end of the day, that is what this fight is about.
That's what I want to build on, the idea of semi-automated cranes, the use of them. And basically they're saying if you use them, you have to have extra workers on hand. And companies, dock operators are basically saying, look, you can't tie our hands in terms of efficiency before we even get started and understand what the technology is. This is going to be a fight that's going to be increasingly difficult for leadership to really weigh in on, given the hope economically for a whole much more productivity.
I'd also throw this in there. Not just what the tech is, but where the tech is coming from as well.
That's a great point.
Been a major issue regarding the next story as well. Treasury Secretary Janet Yellen telling the Chinese Vice Premier that recent hacks of the Treasury Department raise, quote, serious concern about malicious cyber activity. Yellen also warning of consequences for Chinese companies that support Russia's invasion of Ukraine.
So we've heard this before, and I go back to that story with the incredible detail over the weekend that we've spoken about, this Wall Street Journal story, and their sources were saying how Jake Sullivan told these telecom companies in the fall of 2023 about China just lingering and hacking. What I found so interesting when I saw the press release, though, yesterday from Treasury, it was the last line. Yellen expressed serious concern about malicious cyber activity to He Fang. The last line. And after everything we've learned about what China is doing, their pervasiveness across U.S. industries, hacking her and her colleagues' potentially emails, and also listening in on conversations of President-elect Trump, you'd have to think, why didn't they lead with this?
Well, Janet Yellen has been a huge proponent of bilateral conversations and the importance of maintaining communication as a way to avoid some serious altercation. This is probably her last communication with her counterpart over in China, and it raises the question, has it been effective, especially when we're talking about these malicious hacks that are still being unfolded?
Pretty shocking reports. The latest on the United States and China. Let's finish on this story here. Meta revamping the company's approach to free speech. The CEO, Mark Zuckerberg, saying Meta will drop its third-party fact-checking and move to community notes similar to X. Meta will also lift restrictions on some topics and take a more personalized approach to political content in the United States.
It really just feels like this is yet another company that is shifting to the right, reading the tone of the room of the electorate of the United States. Many people you talk to say they feel like corporate America has gone to left. Meta now, Nick Clegg is out. Joel Kaplan will be running the scene. And I think adding Dana White, I think really tells you the tone and the tenor potentially we could see out of Meta.
There's also a larger question here about, A, where the liability lies, right? They don't want to have the liability of a news organization, so they want to step away from that. But number two, what the role is of some of these social media companies and whether this is actually just removing politics or whether this is just injecting a new form of politics on different types of businesses remains to be seen. Social media still needs to be worked out in terms of the main way a lot of people get their news and, frankly, what kind of filters people are. Look, we all hope it becomes the town square where everybody can actually voice honestly their opinions. Let's hope that this moves more toward that.
Metals down in the pre-market by about 0.6%. Not a big move. Plenty more updates on that story a little bit later. Let's turn to the Federal Reserve. Investors are waiting December Fed minutes and more Fed speak this week. Jason Thomas of Carlyle saying, though policymakers keep using the word restrictive, it may not mean what they think it means. It may be time for the Fed to leave well enough alone and retire the presumption that this economy cannot withstand rates at these levels. Jason joins us now for more. Jason, welcome to the programme, sir. Let's talk about that word restrictive. What guides your view about how restrictive we actually are?
Well, if you look at the last 18 months, the real Fed funds rate has been in excess of 2%. That should be very restrictive. But yet over that same horizon, we've had real GDP growth that's averaged nearly 3%, almost twice the level most forecasters had for the U.S.'s potential growth. We've had productivity growth that's exceeded 2% on an annual basis for the last 5 quarters. And of course, we're left with core CPI that is still above 3%. When you add in measures of financial conditions, stock valuation ratios, credit spreads at 17-year tights, I don't see restrictiveness anywhere one would look in the data. And I think it's time to retire this language because in many ways it's also created some damage because it's created expectations among market participants, among investors, management teams, that they should delay transactions, delay interest-sensitive purchases 6 months, 12 months, 18 months into the future when rates are lower. So I think just abandoning this language, changing the rhetoric, accepting that it looks to we're more or less at neutral today would actually be, I think, quite helpful in terms of many of the elements of the economy coming to terms with rates likely persist near these levels.
Jason, what do you see the message as from the long end of the yield curve? The idea that as the Fed has cut by 100 basis points, the long end of the yield curve has risen by 100 basis points.
I think it's the market repricing neutral. The term premium is estimated, right? It is the 10-year yield in relation to expectations for short-term rates over those 10 years. What are those expectations? I think that right now, it's not so unreasonable to think 4.25 is going to be where the Fed funds averages over this 10-year period. If so, 10-year yields at 4.60, that's not really much of a term premium, at least when we look historically. The term premium in the 90s averaged about 150 basis points. So I think that we've been so used to during the period of QE, during the very large reserve accumulations, China, other central banks, we became accustomed to a term premium that was zero or negative. And so a term premium that's modestly positive, people think, oh, boy, this is a sign of concerns about the fiscal outlook or just the sheer volume of bond offerings. But I think a much simpler explanation is that the neutral rate has just been repriced by markets and it's moved into the 4.25 range.
Jason, when you look out over 2025, you just put out a paper talking about some of the big questions for the year ahead. If you look at just where the market is setting up, the market seems to be positioned for U.S. exceptionalism, tariffs that are going to affect the rest of the world, not necessarily the United States in a negative way, and the idea that we're going to get a soft landing with a few more Fed rate cuts at the same time as technology really does increase efficiency across the sphere. Where would you push back against that market positioning?
Well, I think first we have to wait and see what Europe is going to do in response to the U.S. election result. 14 months before the U.S. election, European Commission President von der Leyen commissioned a report from ECB President Draghi. And we'll see if they act on it. People talk about Europe's security dependence on the United States. But over the last few years, there's been an increased economic dependence. European exports to the United States are up 52% since 2001. Over the same period, European exports to China have basically flatlined, largely because of the sudden emergence of China's auto sector. So I think I would pay very close attention to changes in Europe. It's priced about a 40% discount to the United States. Obviously, market participants are not especially optimistic about the likely changes there. But that provides a pretty significant risk compensation to investors. Secondly, I think most people are focused on NVIDIA, AI. I think we should increasingly focus on NVIDIA's customers. The four largest customers in the United States their capital budgets roughly doubled from 2023 relative to intended investment in 2025. Data center investment in the United States up eightfold over this period. We're going to see how productive these quote-unquote AI factories are. And I think that this is going to have a big impact because the valuations of these companies are implying that the return on this capital is going to be in a 25-30% range. And we're waiting for the proof in the pudding. We don't yet see clear evidence that there's going to be the downstream revenues and applications necessary to justify all those outlays.
Are you basically saying, Jason, that you're bullish right now on Europe and getting a little bit more bearish on U.S. big tech?
I think that, in the past, big tech in the United States had enormous price-to-book ratios, the valuations, because, you don't value a money printing machine based on the cost of the paper or the printing press. So these were very rich in intangible assets. Over the last few years, what you've seen, I think, is effectively a change in strategy and a move to a much more asset-heavy business model. If you look again at just the top four customers in NVIDIA, their capital budgets have gone from just 0.1% of U.S. GDP to now over 0.7% of 1%. So 0.7% of U.S. GDP. I mean, this is really phenomenal increase in spending. And the valuations have actually increased over this period of time. Price-to-book ratios have actually gone up even as they've moved to an asset-heavier business model. So again, this is interesting. It's certainly curious. And I think when you look at what is cheap, what is not at risk of a valuation decline related to, again, rates being higher for longer or just a revision to growth expectations, I think much of the rest of the world, but especially Europe, you are getting pretty well compensated. And also, I would say that, the euro, I think it's reasonable to expect that it is going to break through parity by June. So, by the second or third quarter of this year, you could have, if you're a U.S. dollar investor, you could be looking at a European market that looks exceptionally cheap, both in terms of the valuations, but then also on a currency-adjusted basis.
Jason, are you almost saying at the end of the day, an antagonist approach from an incoming Trump administration might force the Europe to actually find its own growth and be a great place for investment?
And we'll see what they do. But the issue in Europe is not the lack of tools, the lack of resources. Europe saves more than the United States in terms of just raw financial resources. They have more than the United States. It's been a lack of political will. And it's also been an assumption, and Draghi calls this out in his report, that actually the inaction is the only way to preserve consensus. Well, inaction is actually deepening political divides in Europe. So we'll see. Of course, we have a German federal election in February. We'll see, what that signals about the electorate's appetite for change. But I think perhaps even more importantly, it could signal to policymakers the sorts of changes that could be in store if they don't reform. So yes, I think that this Trump election victory could be a very important impetus for changes that in many ways are long overdue.
Jason, appreciate your time. Really thoughtful stuff, sir. It's good to hear from you. Jason Thomas there of Carlyle, particularly on Europe at the end. Europe's issues are so deeply, deeply cultural that it's going to take a lot more to get them out of this hole.
Does it take much, though? If it doesn't take that much, if it just is a slight upside surprise or a slight sense that there could be leadership, Jason's point is it doesn't take that much based on where it's priced.
Saw evidence of that in the last 24 hours in foreign exchange. It's a point we've made on this show a few times. Euro dollar right now just short of 104, 103.95. With an update on stories elsewhere this morning with your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. Meta is revamping the company's approach to free speech. CEO Mark Zuckerberg says Meta will drop its third-party fact-checking and move to community notes similar to X.
After Trump first got elected in 2016, the legacy media wrote nonstop about how misinformation was a threat to democracy. We tried in good faith to address those concerns without becoming the arbiters of truth. But the fact-checkers have just been too politically biased and have destroyed more trust than they've created, especially in the US. So over the next couple of months, we're going to phase in a more comprehensive community notes system.
Meta will also lift restrictions on some topics and take a more personalized approach to political content in the U.S. Dell, meanwhile, is rebranding its PC product lines in a bid to revive weak sales. It dropped decades-old names like Inspiron and XPS in favor of simplified Dell, Dell Pro, and Dell Pro Max lines. AMD said Dell will use its chips for some of its business computers for the first time, a blow to rival Intel. President-elect Donald Trump has reiterated his ambition to buy Greenland as his son, Donald Trump Jr., prepares to visit the Arctic island. Trump promised to make Greenland great again after news of his son's visit emerged late on Monday. Trump wrote on Truth Social, Greenland is an incredible place, and the people will benefit tremendously if and when it becomes part of our nation. We will protect it and cherish it from a very vicious outside world. That's your Bloomberg Brief. John.
Danny, thank you. Watch this space. Up next on the programme, the case for higher for longer.
They understand that the economy is doing okay. Inflation is a little bit sticky, so it makes sense to wait. We're going from a period of low uncertainty to much higher uncertainty, and that's what's got to get priced into markets.
Up next on the programme, we'll catch up the former Chicago Fed President Charles Evans from New York. You're watching Bloomberg TV. Stocks up for two straight sessions. We're up again this morning by close to 0.2% on the S&P. Bond yield's a little bit higher as well. Some headlines in the bond market in the last 24 hours. The 30-year yield, the highest since 2023. In the US and the UK, the highest since 1998. Just unbelievable. Under surveillance this morning, the case for higher for longer.
They understand that the economy is doing okay. Inflation is a little bit sticky, so it makes sense to wait. They also understand that there's a lot of uncertainty about what policy is going to be forthcoming. And Powell said when things are uncertain, you should slow down. So I think that all makes a lot of sense. I think the big disconnect, I think, between markets and the Fed is where's the Fed heading over the medium to longer term? We're going from a period of low uncertainty to much higher uncertainty. And that's what's got to get priced into markets.
So here's the latest this morning. Fed Governor Lisa Cook saying the FOMC can proceed cautiously on further rate cuts with inflation pressures remaining. The former Chicago Fed President Charles Evans writing, I expect inflation will return to 2% within the Fed's current timetable. They don't want to risk cutting rates and then need to backtrack higher if inflation rises again. Charles joins us now for more. Charles, welcome to the programme, sir. Just want to go through a range of comments we've had from Fed officials over the past few days. Governor Cook said inflation has been stickier. Governor Kugler said, obviously, our job is not done. President Daley said we're uncomfortably above our target. Why do you suppose, with all of that in mind, they reduced interest rates at the last meeting?
Well, I think that, the Fed has done a readjustment in the stance of monetary policy. They've cut rates by 100 basis points over the last year, since September. And the last cut in December was a close call, according to Chair Powell. So I think they're well positioned at this point to deal with the risks that they expect to be facing this year. And I think there are an awful lot of risks. Inflation has been bumpy, and their focus is on getting inflation back to 2%. They are looking at a projection themselves of core PCE at the end of this year at 2.5%. That's a little bit more than uncomfortably above 2%. And they don't give any indication that they're willing to sort of say, well, 2.5 is really not that far above 2%. So with their focus on 2%, I believe the Fed policymakers that they are going to be patient in adjusting monetary policy, and they're going to need to see improvements in inflation.
How concerning is it to you that longer-term rates have risen so much since the Fed finished cutting by 100 basis points last year?
There are a lot of things going on at the same time. And so it is the case that the Fed funds rate is lower. That would put downward pressure on the 10-year rate for sure. But it's also the case that, their fiscal deficits are continuing to be high. There's a lot of uncertainty about that. How are investors going to be responding to that? And so I think it's natural to suspect that funding rates could be higher at the long end. It's also the case, that productivity is higher. AI offers a lot of promise. Growth has been above 2%. Our assessments of long-run trend tend to be about 2%, but if they're higher, that would also justify higher long-term rates too. So there are many things in play, plus all of the uncertainty associated with volatility and tariff commentary.
How much are you concerned about the fact that the Fed hasn't really put out a framework for how they're going to deal with some of the potential policy changes that are coming out? This was something that former New York Fed President Bill Dudley was talking about. Do you think there needs to be a better communication of scenario analysis around tariffs and around potential immigration changes?
The Fed communications is always difficult. It's difficult for central banks. It's difficult for any institution that is dealing with uncertainty and talking about what they're going to be doing over the next 6 to 18 months. Uncertainty is just very difficult to describe in a way that many readers can fully appreciate. The Fed has a number of communications tools. The summary of economic projections are one of them. And so, by the Fed's own take, they've indicated that they're expecting inflation is going to be higher than they previously thought for longer, and they need to take action. You could go through a few different scenarios where, well, it could be better than that, and explain how, the funds rate would fall. Or you could say it's going to be worse than that. They have internal documents where they go through that. I'm not convinced that the public would be able to digest 3 scenarios when they have as much difficulty with one. You'd constantly be going, well, which of the 3 do you really think we should be paying attention to?
Speaker Johnson is talking about this potential one big reconciliation bill by May. If that is the case, does the Fed then just stay on the sideline and wait for the policy chatter to become actual legislation?
Well, I think the typical Fed approach, Chair Powell has tried to describe this at the last couple of press conferences, which is to, observe the legislative process, observe the progress. When do they get legislative language? When is it about to actually take it be enacted, and what actually ends up in the bill? A lot of things end up, with the last minute in a bill or get taken out. And so it's very difficult to have confidence that you know exactly what the stance of fiscal policy is until you get, real language there. And I mean, if you just go back, previously when you've talked about eliminating the Affordable Care Act, that would have huge implications for the economy, and it came down to a single vote. And so, you have to actually go through the process before you can fully appreciate what that's going to do to the economy. That's part of the uncertainty that I was talking about. Right up until the end, it could go either way sometimes when it's a coin flip, with very large implications for the path of the economy.
You've lived it. We appreciate your experience, former Chicago Fed President Charles Evans, on the latest effort from the Federal Reserve, a Fed that seems to be swinging between 2 risks. One risk being cutting too soon, too much too soon, and another risk being too restrictive for too long. And I'm not sure they know where they are.
And that's the reason why we're going to hear a lot of patience. The question is, what exactly does patience mean?
Coming up in the third hour of Bloomberg Surveillance, we'll catch up with Omar Aguilar of Schwab Asset Management, Dan Niles of Niles Investment Management, Dana Peterson of the Conference Board, and Brian Weinstein of Morgan Stanley. From New York, you're watching Bloomberg TV.
Market, I think, is more focused on the near-term effects of tariffs.
The markets will cheer a narrower approach to tariffs.
Markets have been sort of underestimating how much the Trump administration likes tariffs as more than deal-making.
I don't think any of us know. I'm not even sure the administration knows what the final set of tariffs are going to look like.
We're still in this waiting game. Things are proposals right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
It is January 7th, and it already feels like things are getting a little bit too breathless. Not even had an inauguration yet. That's on January 20th. Still got to go at the payrolls report on January 10th. Once you've got all that, still need to figure out the direction for policy, for tariffs, for how big this one big beautiful bill is actually going to be, and whether it will be one big beautiful bill or whether it will be 2. There's a lot of things we've got to figure out.
You said it feels breathless. Well, let's see if anyone can catch their breath. I think that yesterday was a perfect example of that. The whipsaw of headlines coming out. It's going to be pared back tariffs. No, it's not. What are you talking about, from Donald Trump? The moves in the market highlight a couple of things. How offsides into how crowded trades people are, long dollar U.S. exceptionalism, and the question of what it takes to truly disrupt that.
Also, this won't be an administration that's like watching paint dry. President-elect Donald Trump is going to want to maneuver, and he's going to want optionality, which means there is going to be a lot of whipsawing. But Jonathan, to your point about this optionality of 1 or 2 bills, potentially by Friday, we're going to have 2 bills because he's going to Washington, D.C. tomorrow. He's going to meet with Senate Republicans. And guess what? They want a 2-path approach to enact his agenda. Very different than, well, the congressman is going to meet over the weekend. So then on Monday, we're going to have a different narrative. And that is what we have to get used to.
The backdrop for financial markets is just absolutely amazing at the moment. We've got long-end yields at levels we haven't seen for a number of years, since 23 for the 30-year in America, since 1998 for the 30-year in the UK, and questions about how much fiscal space we actually have in 2025 for various governments at a time we're seeing big changes to political leadership too. And these are all things investors have got to think about.
Especially given the fact that you've got a lot of debt issuance on all sides of the Atlantic, right? I mean, this is sort of the point about how much fiscal space. You talk about that with the United States, with the auctions this week and just going throughout the year as the deficit does deepen, but also in the UK. And questionably and arguably, they have that much less fiscal space with those debt auctions, maybe spurring this rise that you're talking about to the highest levels on those yields and long-end yields in the UK going back to 1998. A question here about whether this is noise or whether this is signal for the path ahead at a time when some people are saying, as we just heard Charlie Evans say, formerly of the Chicago Fed, inflation still is on a path to 2%.
I'm getting some signals from corporate America. These aren't just questions for the government. They're questions for companies as well, worldwide. Brings up Meta. If you're just joining us, welcome to the program. About 60 minutes ago, we heard this from Facebook. Starting in the United States, we're ending our third-party fact-checking program and moving to a community notes model. We will allow more speech by lifting restrictions on some topics that are part of a mainstream discourse. The latest from Mark Zuckerberg and company.
And that comes after a number of personnel changes at Meta, decisively moving to the right, whether it's Dana White being put on the board or whether now Nick Clegg is out and Joel Kaplan will be the head of global policy at the company. And this is just an additional company that's moving away from some of the left approaches we've seen at corporate America. Walmart came out yesterday. At the end of the year, we heard from the likes of Boeing and John Deere. Jonathan, you always say this, and I thought about this yesterday when I saw these moves, what Michael Jordan would say, which is that Republicans buy sneakers too.
All I can say is that this is also a bit of a kowtow to Elon Musk, that we're moving to the same model that Elon Musk has. And when you take a look at all of the potential people coming into the new administration tied to technology oversight, all of them are friends or connected to Elon Musk in some capacity. So you have to wonder how much this is an effort on that front as well.
Right. It's the PayPal mafia. You landed it nail on the head. Those are the individuals that they're either talking to behind the scenes or that are getting seats at the table. What is interesting, though, is you hear a lot of people saying that there's been a shift too much to the left in corporate America during the last 4 years. Will they make the same mistake, though, and go too far to the right instead of what, Jonathan, you said earlier, and what French Hill said, the congressman of Arkansas, of just getting politics altogether out of the C-suite?
Or are we just replacing it with a different kind of politics? I think back to earlier this year, after the assassination attempt on Donald Trump's life, and the conversation that we had with Mark Zuckerberg, Emily Chang sitting down with Zuckerberg. And I think that was the moment, at least around that time, where you really got a sense that Mark Zuckerberg had woken up to the reality that we were about to get a second term from President Trump. It turned around to Emily and called it badass, one of the most badass things he's ever seen. And since then, you've just seen a series of changes come from Mark and the company.
Mark and the company, as well as, and he was one of those individuals that went down and had dinner with President-elect Trump at Mar-a-Lago. But not only that, Jeff Bezos, another individual that was seeing the change of tone. He's tweeted 3 times this entire year. 2 of them were about Trump, and one was denying a report about a $600 million wedding.
It's a big change. Equity futures right now on the S&P positive by 0.1%. Coming up this hour, we'll catch up with Omar Aguilar of Schwab Asset Management as stocks notch back-to-back winning days. Dan Niles of Niles Investment Management as the Max 7 returns to market dominance. And Dana Peterson of the Conference Board counting down to payrolls Friday. We begin this hour with stocks higher as the AI frenzy once again takes center stage to start the year. Omar Aguilar of Schwab Asset Management looking for rotation. Themes such as the broadening of earnings growth beyond tech and mega caps and the potential resurgence of small and mid-cap companies may present compelling opportunities for investors. Omar joins us now for more. Omar, welcome back to the program, sir. A lot of people said the same thing, and then December happened. What went wrong?
Well, I don't think. Good morning and happy New Year to everybody. And I don't think anything went wrong in December. I think it was a very natural reduction of risk and repositioning going into next year. We had an amazing, 2024 where a lot of things went right. And I think the investors just took a little breather just in preparation for what is, going to be a very interesting 2025. When you think about just the level of small, negative returns that we had relative to the entire year, when you put all the pieces together, the S&P and most of the equity markets, ended up having a pretty consistent performance for 2024. I think what is interesting going into this year is this rotation that is mostly driven by, how momentum is shifting. It is sort of what is compelling, and these levels of volatility that we have observed so early in the last couple of days that have, still, trying to see which one of these sectors will lead the way is probably the most interesting part we're going to see in the first quarter.
Well, Omar, we know what's led the way over the last 12 months. Big cap tech absolutely dominated. Is there anything to believe that's going to change in the quarters to come?
Well, if you just look at the top 20% of the what is called the momentum stocks, those have outperformed the market by around 20% on a cap weighted basis. And as you said, most of that has been dominated by the top 7 or the top 10 AI tech related companies. What we have observed over the last 3 months is that top 20% of momentum is now starting to just be a little broader, where there's financials, there's media, there's entertainment, there's other companies that have inched their way into that top quintile of momentum, which also is consistent with what we've seen in the interest rate cycle and the macro environment. So what we have observed here is that now we're going through, the discussion that we had for the entire 2024 about what kind of landing we had, whether it's going to be a hard landing, a soft landing, whether it's going to be a recession. That seems to be just old news. And now we're going into this process where, everything seems to be pointing towards that the recovery. What leads the recovery tends to be cyclicals, tend to be small cap, tend to be, part of the process that we already seen, at the beginning of this year.
At the same time, Omar, you are neutral in duration. This isn't necessarily a rates call. So you think that the cyclical area can actually rally and overperform even in a rate situation that doesn't change that much from where we are. Is that correct?
Yeah, well, this is an interesting piece. What I was discussing earlier, it's obviously relative to what I consider to be a more orderly positioning of equities. I think fixed income and bonds are still in a very wide range of possible outcomes. And I think we're preparing ourselves for another year of a lot of uncertainty and a lot of volatility in yields as we go in through this year. We're already seeing that increase in the long-term yields, in the first few sessions of this year. We've seen that the yield curve is clearly steepening, and it's steepening pretty fast. And a lot of that is as a result of inflation expectations, is economic growth, and also just the term premium continue to just be, pretty high. When you put all the pieces together, the potential range of outcomes within, the fixed income, it is pretty high. So I would probably say that the reason why we continue to emphasize to our clients to just try to stay neutral to their duration is because it's very unclear, where this thing is going to go. And I think it's going to take probably a few more data points and a few more decisions by the Fed to figure out where the yield environment will take us.
Given that backdrop, Omar, we were speaking with Torsten Slok earlier, who said there is this concern we could see a repeat of what happened in 2022 when both bonds and stocks sold off. In this type of environment, what does diversification look like?
Yeah, it's interesting because that is, a discussion we have had, not just recently, but even in the last, quarter of 2024, where, the concern is with good performance on equities and all of a sudden with the uncertainty in yields, is there a possibility where things will just need to be, different? There's two things. One is, the concept of what we have on the short end of the curve. So what is being cash or cash equivalent, that seems to be extremely, positive and a very good foundation for what comes ahead. So it is a very different environment we have in 2022, where the prospect of, where the short-term part of the curve was going to be was very different than what it is now. We're seeing in the process where we know the potential path for the Fed, maybe the speed of where, how many cuts we're going to have and how many, how fast they're going to go in 2025 is still unclear. But we know that at least the short part of the curve is going to be contained in a place where it is going to have a good foundation for the rest of the market. Now, when we actually actually see about the correlation, and we do a lot of work in terms of just correlation of asset classes that have been, very consistent in the way that we had, over the entire history, where we have the negative correlation you expect between fixed income and equities that seems to be pretty healthy. Back in 2022, if you recall, at the beginning of 2022, both equities and fixed income were expensive. What we're actually seeing right now is the relative valuation and the equity risk premium seems to be, in a place where we still think that equities tend to have a little bit of an edge, but the correlation structure seems to be working the way that investors, should use for diversification. That being said, we're always encouraging, clients to look for other sources of diversification, especially, as they look in potential alternatives and any other asset classes that can give them a little extra, diversification.
It's why the likes of Bitcoin has done so well over the last year. Omar, it's good to hear from you, sir. Omar Aguilar of Schwab Asset Management. That last note on bonds, an important note. This is something that Mike Wilson and the team over at Morgan Stanley have been reflecting on. The decisive negative correlation between what's happening with bond yields and what's happened with stocks. Bond yields up and stocks down. I think there's a reason for that. It's the why yields are going up that's starting to get onto people's nerves, I think, just a little bit more. Mike Wilson pointing out that economic surprise indices have fallen and thus are not the driver of high yield. So this is not about economic data. And maybe it speaks to those deficit concerns just on the margin, just a little bit more.
This is the dark matter point that Neil Kashkari has talked about, the term premium, which raises the question of, is this because of concerns around the deficit? Is this concerns about just inflation remaining too sticky? It doesn't seem to be stemming right now from increasing growth expectations.
Mike Wilson joining us tomorrow morning, 7 a.m. Eastern Time, so don't miss that. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Joe Biden is establishing 2 new national monuments in California, protecting 848,000 acres of land. The proclamations creating the Chuckwalla National Monument and the Satitla Highlands National Monument mark another initiative to establish his legacy. According to the White House, both new national monuments only reserve federal territory, not state or private lands. McDonald's is no longer setting aspirational representation goals, a revamp of its approach to diversity, equity, and inclusion policy. The company is retiring its DEI pledge in its supply chain, renaming its diversity team as the Global Inclusion Team. McDonald's cited the evolving landscape around DEI in the U.S. as a factor in its decision. And prices for used timepieces fell last year, with the Bloomberg Subdial Watch Index at its lowest since 2021. Popular Rolex models dropped 5%, Patek Philippe dropped 4%, and Audemars Piguet lost about 7.5%. Cartier is the only brand whose individual index has posted gains since January of 2023. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes. Up next on the programme, the Morning Calls Plus, Dan Niles of Niles Investment Management on the changes coming to Meta and a whole lot more. Looking forward to this with Dan in just a moment. Stocks up again this morning, positive by 0.2% on the S&P, building on 2 days of gains on the benchmark in America. Let's get you some morning calls. First up, UBS upgrading Bank of America to buy, saying it's an overlooked winner of 2025 and is set to benefit from a capital markets resurgence. That stock is up by 1.3%. Your second call from Nathanson downgrading Apple to sell, citing high valuation, antitrust overhang and a weakening position in China. That stock is down 1%. And finally, Bank of America downgrading Tesla to neutral, warning of execution risk and saying upside drivers are already priced in. It's a rare downgrade. A stock is down in the pre-market by 1.7%. Let's stick with tech. Meta, revamping the company's approach to free speech. The CEO, Mark Zuckerberg, announcing a number of changes, including the removal of third-party fact-checking and a move to community notes. That's very similar to what we see on X. Dan Niles of Niles Investment Management knows this sector better than most, and Dan joins us now for more. Dan, Happy New Year, sir, and welcome to the programme. I guess my first question to you on this story would be, is this about insulating themselves from potential regulation, or do you really think this move towards the centre and away from liberal policies will actually deliver better growth, better numbers, and help the stock?
Yeah, I mean, I think, I grew up in California. I lived there for over 30 years. And, the politics have changed over a long period of time, and Meta was very left-leaning with their platform. This just kind of gets them closer to the center. I love Michael Jordan's statement from a long time ago that Republicans buy sneakers too. And I think a lot of companies kind of forgot about that. And so I think this moves them more towards the center, and that on the margin, that should be helpful because everybody hopefully feels a little bit better about the platform.
Dan, how much, when you take a look at 2025 performance, particularly in the tech space, how much does regulation play into it at a time where there are increasing national security concerns and we talk about the sort of increasing decoupling between the U.S. and China?
I mean, I think it's a big deal because in China, their government tries to support their biggest companies. They want their biggest companies to dominate worldwide because China wants to rule the world. And in the U.S., we've sort of developed this policy of, we need to hamper our big tech companies. But guess what? If we hamper our companies and other countries are trying to help theirs to dominate, that puts the U.S. on a national security level in a very bad spot. So the government should really be trying to figure out how do we harness the brilliance we have in all of these U.S. companies, the technology they have, and how do we help our companies spread our values around the world? So I think, hopefully that's what's going to be the case going forward with the new administration, where there's a little bit more support for our technology companies. And I think that's a good thing from a long-term perspective.
I want to give you a victory lap, Dan. Last year, at the start of the year, you predicted about a 20% gain in 2024. We got close to that, more than that, but a lot of people had been expecting a lot less than that. This year, your outlook seems a little bit more cloudy. How much do you think we're going to basically take back a lot of those gains that we had last year with the threat of inflation and the threat of maybe some of the promises not coming to fruition?
Well, I mean, I think you framed it perfectly. If you look at where inflation is, and inflation's really been the biggest driver of stock prices for the last 4 years, arguably. You had big surge in inflation in 2021. Market ignored it. CPI went from 1%, 1.4% to 7% in 2021. Market went up 27%. You got into 2022. And people said, inflation's not transitory. Fed starts hiking, market goes down 19%. Inflation comes down. 2 years ago, market goes up over 20%. As you said, last year, the market was up over 20%. But this year, if you look at it, all the inflation metrics kind of bottomed in either June or Q3 and have been going up. And the market sort of has ignored that right up until Jerome Powell said, our inflation forecasts have, quote, kind of fallen apart, and the market went down 3% on December 18th. And I think that's the risk because the Fed is probably on pause, is my opinion. You might get rate hikes. In that environment, a trailing PE of 25 times when historically it's about 19 times when CPI is between 2.5% to 3%, that's potentially a problem. And by the way, bond yields are also about 100 basis points lower than they normally are when CPI is between 2.5% to 3%. So that's why I worry about a 10 to 20% drawdown this year if inflation does, in fact, look like it's being sticky or moving up. The Fed has to hike. If we thread the needle and you end up with inflation not having a problem, you could see the market up over 10% with multiples holding and earnings growing 10%. But that's why I feel like cash is one of my top 5 investments for starting this year. Last time I had that was in 2022. Market went down 19%. We'll see what happens this year.
Dan, I was just looking at your 2025 top 5 picks, and below cash, you had Cisco. You just talked about these big Chinese tech companies and why there needs to be strong U.S. tech companies. Are you concerned about what's going on with Chinese hackers? Because Cisco was named as one of these companies that Chinese hackers compromised their large network routers.
Well, I mean, the Chinese companies have compromised Cisco. They've compromised the Federal Reserve, which you might remember got hacked. I mean, it goes back to what we talked about earlier, which is you need to support the U.S. companies and what they can do to try to make America's defenses better. And so I think with Cisco, it's one of our top 5 picks. They've got some good security products that obviously all security across all companies, even the security software companies have gotten hacked, which you probably remember. I think that'll really help U.S. networks. And it's one of the reasons we have some of our top picks, like Adtran, which is you're starting to pull Huawei out of a lot of telecom networks now in Europe and replace them with, more friendly country technology. I think that helps one of our top 5 picks, Adtran, as you roll out that technology in Europe, you pull out Huawei out of a lot of those networks as well.
So basically, anything that is U.S. tech will dominate. Do you think that is because the political policies, or that is because these companies just no longer trust this Chinese tech?
It's taken a long while for Europe to kind of get there, but they've finally gotten there. The U.S. obviously started going down that path many years ago when we had President Trump's first term. And so Europe is sort of catching up to that. And I think that's a good thing. And it should help U.S. tech companies where we might not have the lowest cost product, but hopefully it's a little bit more secure and in alignment with our partners in Europe.
Dan, we've got a lot to talk about in 2025. Looking forward to catching up again soon. Dan Niles there of Niles Investment Management. Got a lot to talk about a little bit later as well. 11:30 Eastern Time. Bloomberg's Ed Ludlow sitting down with Jensen Huang live from CES in Las Vegas. Looking forward to this one.
How many leather jackets do you think he has?
I've got no idea. Danny was mentioning earlier that maybe that had sort of like crocodile leather on it, and that's why it was glistening.
Or it was glitter.
In the lights. Do you notice that?
I think these are the important questions that we want to know,
Everyone's
obviously.
commenting on the same thing. I couldn't care less.
Yeah, well, I do think that it sort of is a trend setting, I mean, this is what Mark Zuckerberg's trying to do with his new look, his necklace, T-shirt.
Wear what you want when the stock's up 300%, right?
I mean, basically.
You can get away with absolutely anything. Wear the same thing every day, all the time.
Yeah.
Do whatever you want. Things get a little bit more dicey when the stock's not doing well. Do you remember when Zuck used to go around with the hoodie all the time?
I do.
Yeah. It was great when the stock's up.
Right.
And then the stock wasn't doing so well.
And all of a sudden it was the cost cutting and we got serious.
He used to put a suit on.
Yeah, exactly.
Put a tie on.
Yeah, necklace. Look, with Jensen Huang, I think it's going to be really important that he shows how this is going to potentially go beyond just NVIDIA. And that, I think, is sort of a question. Yesterday we heard why this is great for NVIDIA. With the promise of it expanding, I think a lot of people want to say, show me the money elsewhere.
The biggest clients have spent a lot of money on this. And I think it's the investor patience of the biggest customers that we've been watching for, whether it breaks or not, over the next year or so. And it's one to watch for 25. Up next, we'll catch up with Dana Peterson of the Conference Board, and we'll catch up with Brian Weinstein of Morgan Stanley Investment Management. We'll do all of that in just a moment. From New York, this is Bloomberg. Checking on stocks. Unless you want to talk about that. You want to talk about that?
No, let's go. Let's talk about stocks. Yeah.
Lisa's Googling how many leather jackets Jensen's got.
At least 7.
At least 7. Okay.
Yeah. One for each day.
He's got enough money, hasn't he?
Yeah.
Equities right now in the S&P up by 0.1%. With 60 minutes to go into the cash open. With your morning movers, it's Manus Cranny. Hey, Manus.
Jonathan, let's kick it off with NVIDIA. I mean, there's a host of notes now come into your inbox in terms of what Jensen Huang said to the market yesterday. I like what Steve had to say. The announcements on robotics, the announcement on automation, the announcement on going into hardware is about deepening the moat of real uniqueness around this stock. Dan Ives, the evangelist of Jensen Huang, we know the phrase, the godfather of AI, but he talks about a $5 trillion market capitalization in the next 12 to 18 months. That's a pretty staggering uplift from the $4 trillion he originally had penciled in. What are robots worth? The whole business, the whole world, probably about $38 billion. Auto business for this company by 2026 will be worth $6 billion. And that personal hardware is now an entry into personal hardware for those AI supercomputer developers at $3,000 a touch. So there's an evangelist moment for Jensen Huang, but there's a halo effect onto Uber. It's our data on your systems. That's essentially what we're hearing here, which is Uber's going to give the data to NVIDIA, and we're going to have a magical moment in terms of autonomous driving collaboration. And this is about leveraging the Cosmos platform. So this is about symbiotic coalescing of two major tech companies. And as Dara Khosrowshahi said, it's going to supercharge the timeline for safe and scalable autonomous. Tesla, speaking of autonomous, of course, we know that Dan Ives has said 15 to 20% of this company's valuation is the cars. The rest of it is autonomous driving. Bank of America takes a bit of a pop at this morning. They downgrade on valuation and execution risk. Yes, they upgrade the price target of $490 from $400, but they talk about elevated costs. Sidebar, the US, of course, has blacklisted one of the major suppliers of batteries into Tesla in China. Jonathan.
It's quite a story. And overnight, Manus Cranny, thank you. That's the latest on the corporate side of things. Lots of economic data in the next several days, including payrolls on Friday. The estimate in our survey, 163K. This came from BNP Paribas. This is what BNP's take is, and I think it's an important question for us all going into Friday. What would it take to this Fed to cut interest rates at the end of this month? We expect the Fed would require a clear miss in key dimensions to spur a rate cut this month. So they'd be looking for, Lisa, payroll growth well below 100K and a jobless rate above 4.3% to get this Fed to consider cutting interest rates at month end.
Would that even be enough, though, given how much we've seen the long end increase and how much they've talked about patience? Would one print that arguably people could say would be noisy for a whole host of reasons, would that be enough? A lot of people are going to be looking at the internals of this report. What's wage growth look like? Where is the employment coming from? Is it mostly still coming from government positions? And those are some of what will go into how it's interpreted by markets.
Here's the latest take from Dana Peterson of the Conference Board on the labour market data, writing labour data will be the focus for markets and the Fed this week. The Fed can be less worried about labour market excesses, but should remain concerned about the effect of higher labour costs on inflation. Dana joins us now for more. Dana, welcome to the show. Before we get to payrolls Friday, we've got some numbers in between just to work backwards on Wednesday, ADP and claims, and then later this morning on JOLTS. Can we start with JOLTS, Dana? What we've seen in the data so far, job openings okay, hiring has been muted, but layoffs are low. Do you expect to see more of the same?
Yes. In fact, if you think about the labor market, it's like a water bottle. The pandemic emptied out all the water, then companies had to work really hard to fill the water bottle back up. The water bottle's full, so it's much more difficult to hire new people if you don't need them. And so that's why hirings are low, but still layoffs are low. And when you look at job openings, we're kind of normalized. We're back to where we were. So I think it's a story of normalization and not necessarily weakness in the labor market.
If you speak to people who are at Citigroup, Andrew Hollenhorst's team, they talk about how a lot of the hiring so far in the past couple of months have really come from government positions, other areas that aren't necessarily representative of a healthy, ground-up, broad-based hiring. How much does this concern you?
Well, I like to look at the level of payrolls, and the level is almost back on the track that we were when the pandemic hit. So if you take a line, a straight line, and draw it up, we're almost back there in terms of the trend. Most people are working, and in fact, there are some areas where there's still a lot of hiring. It's healthcare. Yes, it's government, but these are the areas that are experiencing massive labor shortages because people are either retiring or these are jobs that have a lot of churn, right? You have to physically show up to work. You can't be a nurse or a doctor from home. So those are the areas that are hiring. But again, when you look at the levels, most people who want to work are working. So I think it's more important to look at the levels than the deltas. The deltas are going to be smaller, again, because we're at full employment.
Do you have a sense of what it would take in this report for you to get truly concerned about whether things were deteriorating?
Well, like you said earlier, it's one report, but I like to look at hours worked. And certainly hours worked are kind of back to where they were in 2019. And when you dig beneath the surface, you can see that the hours that have really fallen off have been in those sectors where there's just not much demand anymore. Sectors like manufacturing, also retail, transportation and warehousing. That's all linked to goods. People are done buying tons of goods and no services. They're at a better balance of consumption. But when you look at services, hours, they're doing great. In fact, they're rising. And even for construction, they're rising. So I think there's a lot of health in the U.S. labor market because the economy itself is very healthy. And you need to be careful at what you look at in terms of bellwethers for something that's weird. But I would say we should continue to monitor the unemployment rate for people who've been unemployed for 27 weeks or more. That's after you're done with your unemployment insurance. And we're seeing that creep up a little, but still it's very low. But these are the things that I would look out for in Friday's report.
If you see that number start to creep out, would that be an unwelcome development for the Federal Reserve?
Yes, and I would actually look beneath the surface. Okay, why is the unemployment rate rising? Is it because you have a bunch of people who are being let go, or is it new entrants and re-entrants to the labor market? And again, if you're entering the labor market at the tail end of a boom, it's going to be much more difficult for you to find a job because guess what? All the positions are full. And again, most of the hiring that we're seeing are in those industries that really need workers. There's a lot of churn. You have to physically show up to work. So you have to also raise wages to accommodate that. And just looking at wages, wage growth, yes, has slowed significantly from the heady days of the Great Resignation. But wages are still growing at a pace that are much higher than we experienced in the 10, 15 years before the pandemic. Also, when you look at the ECI, wages plus benefits are both growing at very elevated rates. And companies are not absorbing that into their bottom lines. They're passing it on through inflation. And I think that's one of the reasons why inflation gauges have been sticky, especially services excluding housing.
Dana, you just said there the end of a job boom. Is that how you would describe where we are right now in the labor market? And then what comes next?
Yeah, so we had a huge boom to refill all the jobs that were emptied out, that were vacated at the worst of the pandemic. It took several years for us to get back to that level. And again, when you look at the level, we're much higher than we were at 2019, almost back on the path that we were heading to anyway. So that tells me that the labor market is doing great. So it's really those people who are frictionally unemployed, people who are waiting to jump back in. Now they're having difficulty because companies don't necessarily need them. Indeed, when we talk to CEOs of large firms, close to 80% are saying either we're going to hold on to the workers we have because we're happy, or we're going to continue to hire. Only about 20% are saying, look, we're going to be letting people go. And that's really low. If 80% are saying we like the labor market and we're going to continue to keep it strong, I think that's something we should pay attention to.
So, Dana, just to wrap it up and put a bow on it, given the confidence numbers we've seen from your company and elsewhere as well, for consumers and for businesses alike, you don't think that necessarily is going to lead a pickup in hiring in the months to come?
Well, again, it's like if you're a company and you need 20 workers and you have 20, you're not going to hire that 21st. But the key thing for consumers is the fact that they are working. Most consumers who want to work are working. Again, their wages are growing at a much faster pace now than they were 5 years ago. They have income, they have savings, and I think consumers are going to continue to have that ability to spend. And let's not forget, inflation, the rate of change in prices is much lower. Yes, the price level is higher than they'd like and certainly higher than we were in 2019, but at least prices aren't rising at a rapid rate. So those are all components that support consumer spending. So again, as long as most people are working and they have income, then I think they're going to spend.
Well framed. Dana, good to hear from you. As always, Dana Peterson there at the conference board on the economic data still to come this week, including payrolls on Friday. Later on this morning, the JOLTS job openings report and ISM services. So a lot to look forward to at about 10 a.m. Eastern time. Michael McKee, our Bloomberg economics and policy correspondent, joins us now for more. Good morning to you, Michael. What are you expecting from those numbers a little bit later?
Well, not a whole lot. The ADP numbers are expected to come in a little bit lighter tomorrow, so JOLTS maybe not going to influence the views of that. And at this point, JOLTS has kind of fallen off the radar for the Fed in terms of what it's telling them about the economy. ISM services will be interesting because people will want to see what it is we're getting in the employment side. Again, looking towards Friday. I do want to mention that while you were talking with Dana, we saw the U.S. trade balance for November come out much higher than expected at $78.2 billion. It was the highest since 2022 because of the port strike threat and Trump tariffs. We imported a lot more stuff, but here's the kicker. We're looking at what's going on with China because obviously Donald Trump is making a big deal out of putting tariffs back on China. We imported less from China in November than we did in October. And you look there, that's when Donald Trump put on the tariffs the first time. And what happened? The trade balance actually widened. So at this point, it's hard to know exactly where we're going to go with all this. But I am going to predict that the trade balance going forward, once we get into the Trump administration, is going to be one of your new favorite indicators.
We'll definitely be watching that closely. In the meantime, we're looking ahead to Friday's payrolls report. And I'm wondering what you're looking for in terms of the internal metrics that could potentially be really important for the Fed.
Well, the Fed is really going to be looking at the unemployment rate. That's what they've made sort of their lodestar for where they go from here. But it's also going to be interesting to see how many jobs jobs are created. There is a very, very wide range of forecasts for jobs, from less than 100,000 to almost 300,000. So if we get a big number, then that is going to suggest to the Fed that they could keep cutting rates. But if the unemployment rate goes up, then they're going to be talking about, well, maybe we need to keep the pressure on. So let's see what happens on Friday. It's kind of hard to tell at this point.
A busy Mike McKee this morning as well. Mike, looking forward to your coverage a little bit later, 10 a.m. Eastern time for JOLTS, job openings and ISM services. Joining us now, Brian Weinstein of Morgan Stanley Investment Management. Brian, good morning.
Good morning.
And a very happy new year to you. The 10-year bond yield this morning, 463. You think that's child's play? 525, 550.
That's right.
Is what might be the real test later this year. Are you expecting that to happen as a base case?
This is the first time I've been here where I think we can start to think about the 10-year note making some sense, right? At 460, 2% growth, 2% inflation, a little term premium. So we're now getting to an area where it's interesting. But stocks are at the highs, right? I mean, we've been here before. We've been at 460 10-year notes. You said in the UK, it's been since 1998, right, since we've had these rates. That's not where we are yet in the US. So we're getting interesting. But if we're going to talk about US exceptionalism and growth and tariffs and things that change prices higher, I don't think 460 10-year notes are going to be the thing that stops us.
The path of least resistance for the year ahead then, higher yields?
I think we'll be more two-way starting around here, right? We've had a big move. It was very quick. No one expected it. I don't really understand why we rallied into the Fed like we did. And the path of it, we can argue. But I think the steeper yield curve makes sense. The rate level starts to make sense. And any weak data will start to rally it. But I think when we get to June, somewhere between June and September, we have to test the stock market with a rate that matters. And to me, that rate is 5.25, maybe a bit higher.
So basically, buy tactically now and then sell and then wait.
If I was going to buy something, I think I'd buy the front end, right? Because if you start to think about, something like a negative payroll or something, a really bad data point, right? Listen, unless the stock market crashes 30%, you're not going to get a 100 basis point rally in a 10-year note. But you could price in Fed eases again. So the front end, I would buy. I would wait for duration. Listen, you could trade it around from here, I guess is my point. But I do think you're at the beginning of a fair value in a 10-year note, but not the end of the story.
I've been struck by how many guests this morning have talked about the potential for some sort of 2022 repeat, the idea that bonds and stocks could sell off in tandem, and the idea that we could essentially get bond yields that climb and pressure stocks kind of akin to some of the trends we've been seeing over the past couple of days. What kind of likelihood do you give that scenario?
I think it's very, very high, right? So if you look at the long term, the last 3 or 4 years, we are at effectively the highs in yields and effectively the highs in the stock market. So the correlation is positive, right? I think that has to change, right? It'll go back to 2022. So I do think if interest rates were 5.25, which puts real rates at, 2.5 or maybe even a little bit higher. So you've had 2.5% risk-free growth plus 2 and change or 3% inflation. If you could get a 5.5% risk-free return from the government, I think you have to question all your risk allocations. So yes, I think that we're going to that point where rates are the things that pressure equities.
Dan Niles was on earlier and he said one of his top 5 allocations is cash. Do you agree with that?
Cash is one of everyone loved cash last year, and listen, it did what it was supposed to do. It gave you, 5%, and unfortunately, stocks gave you 25, right? So it didn't look as good as you wanted it to, but it's certainly better than zero. I don't know if it's my favorite allocation at this point, but yes, I think it's supposed to be a growing part of an allocation when duration is not cheap. And stocks are pushing levels where we haven't seen valuations like this in a really long time. So I don't think it should be a number one allocation yet. But I do think as the year goes on, cash is going to be something people will revisit. But again, I think not until stocks. You have to have a chance to reflect on all this new policy that's coming, right? So this U.S. exceptionalism story, the idea that prices are going to go up, the idea that consumers are going to spend, which I think we just heard a good argument for, I think that's all still relevant. So I don't think you have to rush into cash, but it's something you're going to want to own later this year.
Torsten Slok joined us earlier, and he talked about how the move in rates has been so unusual, and he gave all these reasons why. Questioning, is it fiscal worries, less demand from abroad, were the Fed cuts unjustified? What do you give this reasoning to? Yeah,
I love reading Torsten stuff. I think it's interesting debate, I don't think it's an unusual outcome. I think the path was very strange. I think what happened was when the Fed started cutting rates, everyone loves liquidity and everyone remembers the last few times they cut rates, it went a lot further, the economy fell a lot harder, and listen, zero rates were in play, right? So you bought duration. I think people followed the playbook of the last 10 or 12 years. I think to me this looks a lot more like the playbook that came before that, where Fed funds rates weren't going to zero and the Fed was just calibrating. And again, I think the political outcomes were different than everyone expected, which also supercharged that sell-off.
We're getting some markers in the sand on the political outcome. One of them is Speaker Johnson is talking about April, May to get this one resolution, at least one of these packages, if it's going to be two, out the door. Is that, for you, a marker in the sand potentially in terms of, okay, right now we can just deal with this volatility, but at least we have an end game on what the chatter means for policy?
I think it's important. I think it's really important to see with a very small majority how many people come along for these things, right? Because again, if you do get the policy that's been promised, a lot of it's in the price, but there's a lot of skepticism as well. And tariffs, we can argue about the economic textbook implications of it. What everyone is going to see is another change in price level higher. And that is going to cause people to spend more sooner and make things, I think, make the inflationary pressures more sticky. So yes, I think if we can see a move towards a big bill in May, it will convince the markets that this story, that there could be another round of growth in this thing, and that would be a big deal.
I'm hearing a lot of skepticism from you. I'm hearing sort of this bearish overtone that is sort of unfortunate to me that I haven't heard this in a very long time. Are you going to come out and actually be bearish?
We're getting to a point where a lot of this is in the price. Yes, I think if we got to that point where we saw the unification and a big bill coming and we got 10 notes to 5 1/4, I think you're going to reverse some of these trends, right? I don't know that I look at 2025 and see another 20-odd% return in the equity market. It could be a great year for bonds after a really bad start. So I think it might be a tale. It's really hard to time, a tale of 2 years, or maybe it's the first quarter is really strong. But yes, I do think allocating the cash at some point, getting ready to buy duration at some point. These are things we haven't wanted to do in a long time. They're coming, and I just don't know when.
If you're bearish on US bonds, I just wonder how bearish you are on bonds elsewhere. We're questioning the fiscal space already in places like France and the United Kingdom. At least here in America, you can have an argument that bond yields are going up for the right reasons. I'm not sure you can abroad right now, can you?
No, it's messy abroad. It's messy abroad. I mean, look at the euro, right? I mean, the euro going to parity is kind of, I think, the way it's playing out in Europe as opposed to yields, because there isn't the same growth story. There isn't the same inflation story. So it could change. I don't have a big view. There's certainly a mathematical relationship between European yields and U.S. yields, so you can stretch that for a while. But eventually, you're going to want to move your underweights to Europe duration instead. The U.K. is the hardest one, and it always is.
Big time.
It always is, right? The U.K. led us in the 90s, remember, in 2000s, they pushed their long-term investors to own a lot of duration and pushed their long rates way down. We thought it was an aberration, and Japan was an aberration. They were the leaders, right? And now it's changing. I don't have a great feel for where the UK long end could go. It seems a bit messy, the entire situation there. But yes, at some point, the European story will become much more interesting.
I forget the average maturity profile of the UK debt market, but it's certainly north of the United States.
Way north.
By quite a multiple. Brian, it's good to see you, sir. Brian Weinstein there of Morgan Stanley Investment Management. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Meta is revamping the company's approach to free speech. CEO Mark Zuckerberg says Meta will drop its third-party fact-checking and move to community notes similar to X.
After Trump first got elected in 2016, the legacy media wrote nonstop about how misinformation was a threat to democracy. We tried in good faith to address those concerns without becoming the arbiters of truth. But the fact-checkers have just been too politically biased and have destroyed more trust than they've created, especially in the US. So over the next couple of months, we're going to phase in a more comprehensive community notes system.
Meta will also lift restrictions on some topics and take a more personalized approach to political content in the US. Hedge fund Bridgewater Associates has laid off about 7% of its workforce, affecting about 90 employees. A spokesperson for the firm said that the layoffs are meant to keep the organization nimble and flexible. The cuts now bring headcount back to where it was in 2023. Fellow hedge funds Two Sigma and Brevin Howard also cut about 10% of their staff last year. Toyota is aiming to open a futuristic city at the base of Mount Fuji later this year. Toyota says the first 100 residents of the so-called Woven City will move in soon, mainly Toyota employees and their families. Woven City aims to be a living laboratory for testing and developing new technologies, but Toyota's chair has said it may never be profitable. And that's your brief, John.
Danny, thank you. I'm not sure if I want to be part of a living lab, but the accommodation looked quite nice, didn't it?
I don't know. It looks like if you get free accommodations, and it's not going to be profitable because you're getting more value for
apparently flying cars.
Yeah.
Yeah, that's what they talked about.
At some point in the future, who knows? Up next, setting you up for the day ahead, tons of economic data this week. It kicks off a little bit later this morning at 10 a.m. Eastern Time. We'll run you through all of that in just a moment. From New York, this is Bloomberg. The opening about 35 minutes away. Equities positive by 0.2%, up nicely, and to build on the gains of the past few days. Let's see if this holds. Here's the trading diary for the rest of this week at 10 a.m. Eastern Time. JOLTS data, ISM services Wednesday, ADP private payrolls and Fed minutes plus, another round of jobless claims, and on Friday, the big one, Bramo, payrolls Friday just around the corner.
I just have to stop for a second and say, after all the euphoria of American exceptionalism and bullishness and how these are equity markets that can just keep going up and away, carried by AI incredibleness, we are hearing real bearishness for the first time. And I want to just put a linchpin in that, because really today has been all about how we could see a repeat of 2022.
It's based on the guests we've had, right? Torsten and Slok came out with the repeat of 22 line, and we sort of built from that.
Okay, hold on a second. We heard that from a number of guests. Dan Niles, we heard that also just now from Brian Weinstein. I mean, this is not just one guest.
People were baking in policy, which is why I'm looking forward to tomorrow to seeing if we get any more tea leaves, breadcrumbs on actually what the legislation and what Trump's agenda will actually look like when they write it down.
For 5 minutes in 2025, Lisa was on the edge of bullish. Okay, one morning, 3 guests. The whole thing's gone away.
Well, three makes a trend, so that's officially a new trend. We're hearing new nodes of bearishness.
Hyper-dependent on the next data point. We'll get more data later on this morning. Coming up tomorrow, Andrew Holdenhorst of Citi, Mike Wilson of Morgan Stanley, Alicia Levine of BNY Wealth, and Greg Dacko of EY. Looking forward to that. From New York, thank you for choosing Bloomberg TV. For our audience worldwide, this was Bloomberg Surveillance.